standard will help some of these manufacturers. That was a big, deal last year with a lot of announcements, but we won't see that actually come to fruition, until the coming months. And so whether or not that will help resolve some of these charging issues for these other manufacturers will be something to watch.
Hey, Craig, appreciate the update, buddy. It's good to catch up. Bramo, I struggled with it. I struggled with it in the conversation with Secretary Kerry that somehow range anxiety is the consequence of a misinformation campaign.
Well, to Craig's point, I don't think that people are necessarily worried about getting straight out of the side of the road. However, honestly, I was going to rent a car, and I didn't rent an electric car because I didn't understand where exactly the charging stations would be. So I just decided, you know what, I don't really want to complicate my vacation, explaining why perhaps some people are selling.
Clearly you're not alone, which is why Hertz dumped 20,000 EVs.
Exactly.
Well, yeah, but in Italy this summer, I rented an electric car, and there's apps set up to charge them, and it was actually quite simple and easy. Italy has put a ton of money into the south of the country to try to ramp up a lot of this. They're hosting the G7 in Puglia, but you need the charging stations in order for this to work. And if you don't have it, it's quite anxious.
I think we've said this repeatedly. It's not that we're rethinking the destination. It looks like that's locked in based on what governments would like to see. This is about the pace, the speed we get there, Bramo.
Yeah, but the problem is that if you conflate the two, you end up with real mixed messages, right? Which really comes from things like pumping more than 13 million barrels of oil a day and then talking about the evils of fossil fuel creation and emissions. So this, to me, is what is it? How do you have clarity of message while recognizing the necessity of a longer period of transition?
There's a bit of tension between those two ideas, just a little bit. Let's get you up to speed on some of the headlines from stories elsewhere this morning. Let's say good morning to Danny Berger. Morning, Danny.
Good morning, John. Elon Musk is set to visit Auschwitz and attend a panel on online anti-Semitism. It's part of a trip organized by the European Jewish Association. The EJA organized the visit to address a worldwide surge of anti-Jewish rhetoric that followed Israel's invasion of Gaza after Hamas's deadly attack on October 7th. Musk caused an uproar in recent months after endorsing an anti-Semitic Jewish conspiracy theory on X. Frigid temperatures are still gripping much of the U.S., with states as far south as Texas and Florida feeling the freeze. Sub-zero conditions and dangerous driving conditions claimed 72 lives nationally after significant snowstorms blew through eastern states. Freezing temperatures are expected, though, to ease up in the coming days. And the Kansas City Chiefs advanced to their 6th straight AFC championship with a 27-24 win over the Buffalo Bills on Sunday night. The Chiefs ended the Bills' season in 3 of the past 4 playoffs. Now the Chiefs move on to Baltimore to face the top-seeded Ravens. And that is your Bloomberg Brief. John.
Danny, thank you. Impressed that we got through that without mentioning a certain name. AMH.
Taylor Swift.
Just about
she was in attendance. She was in attendance. But I was voting for New York.
Were you?
Rooting for New York, yeah. I don't really follow football, but I rather the Buffalo wins over Kansas City.
Okay, great, yeah. All right. Appreciate the insight. Thanks, AMH. Up next on the program, the Fed dialing back rate cut expectations.
We don't want to loosen policy too quickly, only to find that inflation gets stuck at way above target. That would be a miss.
That's coming up next on the program. You're watching Bloomberg Surveillance.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion. and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Live from New York City this morning. Good morning. Equities look like this on the S&P 500, higher by 1/3 of 1%. Equity futures in positive territory. Yields are a little bit lower, down by 2 basis points, 4.09%. Under surveillance this morning, the Fed dialing back rate cut expectations.
We don't want to loosen policy too quickly, only to find that inflation gets stuck at way above target. That would be a miss. That would be a very scarring miss. And we don't want to try to get to 2 so quickly, like overnight, just to get that squeezed out, that we end up having this big run-up in the unemployment rate.
That was San Francisco Fed President Mary Daly speaking at the San Diego County Economic Roundtable on Friday. Bramo, we heard a lot of that last week.
The sort of perfect balance, but how do you get there? And I think this is the angst. How do you know when you're actually at that perfect balance, given the fact that the hard data looks pretty good? Patrick Harker of Philadelphia Fed came out in a January 18th essay. I thought this really was fascinating, and it has reiterated what he's told us before as well. He said he'll be guided equally by the soft and hard data, writing, quote, "As important as the hard data are, they do not tell the complete story. Soft data help not only better explain what I may be seeing in the economic updates, but can also give me insights of emerging issues that may not show up in the numbers until further down the road." John, this to me is one of the key questions. What are the indicators, the tea leaves that some of the policymakers are looking to know when to make a move?
Anecdotes. Patrick Harker, you remember this, Jackson Hole.
I remember this, yeah.
We sat down with him and we talked about exactly this, what businesses were telling him on the ground.
He said that that was a better indicator when we saw the turn of inflation, when we saw the turn of things going up, than a lot of the hard data. So now my question is, what is the soft data they're looking at? People, businesses telling him that they're not looking very good? Well, actually, they are kind of optimistic. So where's the dissonance here that causes them to cut rates?
Let's see if Steve Major's got an answer, the Global Head of Fixed Income Research over at HSBC. Steve, great to catch up, sir. As always, let's go there. What's guiding you? What's your North Star right now on your dashboard, the economic data that you're looking at?
So the hard data is backward looking. The surveys can be unreliable, and anyone who's taken a survey recently after having a particular service will know what I'm talking about. People are fed up with them. So I'm not sure about the quality of the soft data and the so-called forward-looking data. For me, what matters more than anything else is the distance between today's policy rate and the longer run equilibrium. It's about 3%. I'm not that interested on the date and the amount of the first rate cut, which seems to be where most people are. The next move is down. Where it's either unchanged or down, basically. It isn't up. And that binary outlook for rates makes it much easier to justify a long position in bonds than it did maybe 3 to 6 months ago.
At the same time, Stephen, if they don't cut rates until December, that's going to surprise the market to the downside. So how do you sort of justify being bullish now when we're already seeing a lot of it already being priced in and people getting ahead of themselves?
Yeah, so we've got a neutral call for this month, and I tell my colleagues, look, if it's so obvious we're going sideways for 6 months and then the yields are going to go down in the second half of the year, what are we waiting for? Because you've got the carry and the coupon in the meantime. In the biggest period, the biggest bear market for bonds was in the period 1961 to 1980. The annualized total return was still positive. It was about 4% a year. Now, that kind of thing happened last year. You ended up with plus 4% on the year. At one stage, you were more than minus 10. But that's kind of how bonds work. So Yeah, I get the idea, Lisa. If they don't cut in 2024 for whatever reason, then the 2-year yield should be nearer to 5, and that could push the 10s nearer to 4.5. But that said, they might cut an awful lot too. So you have to balance those two scenarios.
At the same time, we're getting $162 billion of Treasury auctions this week, I should say, 2-year, 5-year, and 7-year. When do we start to worry about supply, especially as quantitative tightening continues?
You know that we get that question quite a lot, and you probably know where I'm going to come from here. The supply side is just one angle in the whole picture. The demand for bonds today is higher than it was 3 months ago, and that's a paradox, because yields at 5%, it seems, were less attractive than yields at 4%. I hope I'm making sense, that there is more demand for bonds today than there was back then. That's because you've got the certainty around the outlook. Rates aren't going up. They're going to be unchanged or down. You couldn't say that for sure 3 months ago. That's why 10-year yields are about 100 basis points less. So there's $5 trillion or so sitting in money markets. Pre-pandemic, it was what, 2.5? So presumably some of that money is now shifting into bonds, or soon will be, because there'll be a huge regret if it stays in money markets and the Fed's cutting.
Steve, you wrote about this in the last 6 months. Does supply matter? We need to talk about supply relative to the cycle. How rare is it to see a deficit this large, Steve? To see issuance that Lisa just went through, with unemployment still south of 4%?
I had a bit of mea culpa last year, you probably remember. I mean, I underestimated the surge in supply, but the context matters. The increase in coupon issuance for the August to November period happened when the curve was deeply inverted, about minus 100 between money markets and bonds. And the US had just been downgraded by Fitch at the beginning of August, and the GDP holding up. Now, the confluence of those three events made it very difficult to justify buying 10s when money markets were 100 basis points higher. Today, you've got different circumstances. We're chugging along, but we're probably closer to the recession. You haven't got such a great inversion. You don't have the downgrades. So it seems to me that the supply is coming into a much more willing demand environment. So you could look at it from the money sitting in money markets. You could look at the level of equity prices. You could look at what overseas investors have been doing. Ultimately, we're going to be talking about the demand for bonds, not just the supply. And what I find interesting is how all the questions seem to be angled at just one factor, the fact that there's some fairly big supply coming up. Doesn't matter. There's plenty of demand.
Well, Steve, I wanted to get into that. Let's talk about both, not just the supply, but the demand. Has the playbook changed? I hear from you that you don't think it has, that we'll still be willing to finance this deficit when the economy rolls over and the tax receipts fall.
Yeah, we've had a couple of episodes that have made us worry. Obviously, I just pointed one out, that August-September period last year in particular. There was what happened in the UK 1 year before that. There's a UK fiscal experiment, but you've seen these things happen occasionally. I think taper tantrum was something similar, but ultimately these are short-term events. They don't determine the long-term value of a bond. A bond's valuation is mainly driven by the short rate and its expected path. Now, what's happening is people are stacking on a load of term premium onto their projections here, which is all very well, but it's just the majority of the bond's value is explained by the short rate.
I can tell that Steve is
this term premium thing.
Frustrated by that question that he's asked repeatedly about supply. Steve, in the heat of Dubai, we're not jealous at all. Steve Major of HSBC. Steve, it's good to catch up. Playbook, Bramo, hasn't changed for the team at HSBC.
Still looking long bonds. Yields are going to go lower, and that seems to be the conviction that continues.
It's that simple. Coming up in the next hour, Bob Diamond, CEO of Atlas Merchant Capital, for the entire hour, alongside Stuart Kaiser of Citi and Kelsey Barrow of JP Morgan.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action at a new time, 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
The market is being aggressive on rate cuts, all right? And I believe that the Fed is going to take its time.
By the end of the year, they will start cutting.
Our core team has 4 cuts, and 4 cuts, 24 and 25.
6 rate cuts. That's a pipe dream if we have a soft landing. That's not happening.
The market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Travis Kelce and Taylor Swift chat in a commercial break. This show is going to kill me. Live from New York City this morning.
You're welcome.
Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Let's turn to the financial markets. Positive by 1/3% on the S&P 500. The last week, things have been decent. Retail sales were hot. Jobless claims were lower. Lisa, consumer confidence is picking up.
It all sounds so good. And at Davos, everyone was so optimistic. And then Max Kettner of HSBC with this cold water this morning. Don't jump on the Goldilocks train. U.S. large caps hitting all new-time highs. We don't think this has much further to go.
MH, the president hopes it does.
Yeah, it certainly does. They want the timeline to be on their side. And I have to say, when the University of Michigan sentiment came out in that confidence report, I got a lot of messages from people in the White House sending me those news stories saying, look, people are starting to feel better about the economy.
Yes, but enough? That's the question. And do oil prices stay low enough to keep that confidence going? I mean, how much is that particular survey completely connected to gasoline prices in the United States?
I have a viewer writing into me this morning saying Exxon, Shell, all on Hillside Avenue in New York on Long Island, $2.99 this morning. That is huge. But to your point, that needs to be the price of gasoline next September, September, October, and November.
The White House wants to talk about consumer confidence. They do not want to talk about the 13 million barrels a day that's produced in this country, that's keeping crude in the 70s and gasoline low, with the exception of one man. Secretary Kerry last week, what did he say? It was necessary. It was necessary.
Well, I asked him, is this a policy of success or a policy failure? And he said it was a policy necessity because if you get higher oil prices, you end up with riots and a lot of social disruption. So here's the question. How do you dovetail a message of sustainability over the long term with reality in the short term, which is people are moving a lot less quickly than a lot of people had expected?
Brent crude right now just south of 80. The broader price action looks like this. In the equity market, a little bit of a lift on the S&P 500. Drifting higher here on equity futures. Yields drifting lower by, let's call it, 2 basis points. Down about 3 now, Lisa, to 4.09%.
Okay, still, we've seen a pretty big sell-off in bonds. And what I find fascinating is that we've reached all-time highs in NVIDIA, but also that has driven the rest of the index, while bonds have sold off. This, to me, is a huge question. Can this continue, given the fact that people are optimistic about the U.S. economy?
Coming up on the program, that 2-week winning streak, taking stocks back to all-time highs. The attention will turn from the financials of last week, Goldman, Morgan Stanley, to big tech of the next couple of weeks, Microsoft, Lisa, and Apple still to come.
Those, to me, are going to be the real determinants of whether we see some of this rally continue. The AI hype, can it translate into actual profits? Are they making headway, or are they just simply defending themselves from interrupters that are sort of going to change the way we search, change the way we do everything, change the way we are employed?
And then later in the program,
potentially.
Very dark.
Well, I'm just
Let's
saying.
not start there.
All right, carry on.
The Republican primary narrowing down to just 2 candidates. AMH, it is Nikki Haley versus Donald Trump.
Yeah, I spoke to the DeSantis camp last night, or someone in the camp, and they just said there's no path forward. He tried to establish himself as someone like Trump, but without the baggage. That doesn't work when you basically have an incumbent in your primary field, Jonathan.
Yeah, well, honestly, I just am wondering who's going to be vice president, when Nikki Haley is going to drop out, and if this is going to be a Donald Trump-Joe Biden matchup. How many people are going to be excited? What's the turnout going to look for this thing that a lot of people aren't that excited about?
The turnout in Iowa was terrible,
Yes.
but that was the temperature, so I imagine that's going to change.
It was very cold.
Well, yeah,
It was
but there's
absolutely
not,
freezing.
But there's not a lot of enthusiasm for this. And everyone who's come on, and a lot of people in private conversations, executives and beyond, saying, really, this is what we got, these 2 individuals, and a lot of people are kind of frustrated by that.
A final headline we need to hit a little bit later in the show as well. The United States struggling to contain Houthi attacks in the Red Sea. The president acknowledging, Lisa, that these strikes aren't working, but then basically explaining they will continue.
This is a really tricky moment. How do you prevent escalation at a time where you have to fortify the ability to trade in the sea, the independence and the safety of the sea? And this, to me, is going to be a quagmire that goes on for a long time. The tit for tat continues, and people shrug it off. It's just tit for tat, and it's avoiding escalation. When does that sort of trip some kind of wire, live wire?
We'll pick up on that story a little bit later this hour. We begin with our top story. Stocks trading at record highs as rate cut optimism is still growing. But Bob Diamond, CEO of Atlas Merchants Capital, warning the following. The Fed is likely to proceed with caution. A rate cut or even 2 this year could occur, but the economy is likely to continue to demonstrate that it can handle the current level of interest rates. Bob Diamond, I'm pleased to say, joins us now and joins us for the hour. Bob, good morning to you.
Morning, Jonathan.
Let's get into the data. It's fantastic to see you, sir. Retail sales were solid. Jobless claims were low. Optimism is picking up. What evidence is that we are, quote, sufficiently restrictive at the Fed?
So, you know, I think consensus, Jonathan, in my mind, is about 1% growth this year. The Fed is a little higher, kind of 1.5% growth. I think it might be a little bit higher than that. And as I look out at the year, if the Fed were to be aggressive in rate cuts, first quarter or second quarter, I think they run the risk of the economy accelerating a bit and therefore inflation accelerating a bit. And that's just a position that the Fed is not going to put themselves in. So my sense is that the right way to look at this, rather than the markets, or if you look at the Fed fund futures, they look at 150 basis points this year, and it's kind of front-ended. My sense is maybe 1 or 2 25 basis point cuts, second half, maybe closer to the end of the year. And I just believe the Fed, for very good reason, is going to remain cautious. They pretty much played a blinder since they recognized that inflation was spiraling, frankly, out of control not that long ago. We're in a very good position now, and I think for the Fed to act too quickly would put them in a difficult position. So Our sense is the markets are well ahead of themselves in terms of rate cuts, maybe second half.
When you say markets, bond markets or stock markets? Because what I find interesting is how many people are saying this is a bond market problem. It's not a stock market problem, because if the economy is better than good, that's going to be positive for risk assets.
Yeah, and I think, Lisa, it raises another issue, which is we were for so long at 0 interest rates or 1% interest rates. I mean, we all remember here, world before 2008. From 2008 until very recently, Fed funds averaged about 1%. Before that, for decades and decades and decades, Fed funds averaged around 4% or a little above 4%. So where we are today is not abnormal. And our sense is that the economy is adjusted reasonably well. We see that in, kind of the calmness in the bond markets, the calmness in the equity markets. So there's not a panic here by the Fed to lower interest rates.
You were at Barclays leading the charge there for quite a while, Credit Suisse, First Boston. You've been in the banking business for a long time. There's a lot of angst about what the future of the banking industry is going to hold at a time where, yes, interest rates are higher, but also there's a whole host of regulation that's crimping the lending activities of a lot of these banks. You've referred to them as utilities. So where is the opportunity at a time where it seems like lending could be profitable if there weren't so many constraints?
So I think we're seeing, point one would be if you look at the U.S. banks, and if you look at what we typically report as earnings, we tend to report the big banks. And the big four, the big six in the U.S. continue to get larger, more concentrated than they were prior to 2008. And I think that concentration does weigh on me a bit. Do we really think that fewer banks, larger banks, more concentrated banks is better for the U.S. economy? I really don't think so. I think one of the things that's been the lifeblood of our economy, and the reason that the U.S. reacts so quickly to negative news and negative periods, particularly relative to Europe and other sectors around the world, is because of the diversification of the financial services industry. So I do worry about that. And I think earnings have been good, but the larger interconnected banks are becoming much more like utilities. And so the push back on higher capital levels, I actually think is going to be ineffective for just that reason, because the banks are becoming more concentrated and they are becoming larger.
So what do you think of this impact of these new capital requirements? If you like the U.S. regional banks, they potentially face even a tougher road ahead.
Well, I think a lot of that capital is for the larger interconnected banks, what people used to refer to as too big to fail. And I think that's where the biggest impact will be. And I can kind of understand both sides of that argument, Anne-Marie. On the one hand, the banks are saying higher capital levels, while we're safe right now, which they are, is going to lower ROE and reduce lending, which is true. On the other hand, if you're a regulator and you're worried about ever being in a position where there's systemic risk or too big to fail, even though the banks are doing great and they are safe today, the risk, if there was a failure of systemic risk, is greater. In my view, and this does fit my book, we really love to invest in the regional banks, and we're looking at it. So I want to claim that that's kind of our bias. But there's 4,000 or so regional specialist banks today. There's no country that has that kind of a financial services industry and that kind of a reach. The benefit that those banks have for small family-owned businesses, which again, the lifeblood of the U.S. economy, is really important. There will be consolidation, and I do think that those banks are reacting well to higher interest rates now versus, the immediate impact of higher interest rates. So we think there's going to be terrific opportunities in regional banks. We love that as a space to invest in, but most importantly, we think it's incredibly important that we provide opportunities for those institutions to continue to grow and serve small and medium enterprise businesses.
Based on that, it sounds like you think we're through the storm of last spring.
In terms of regional banks,
yeah,
for sure. I think there were a couple of things, Jonathan. I think every bank, large, small, medium, had to adjust their portfolio to higher rates. When rates go from 1% to 5%, it's going to impact. You can't have a positive impact of that. You have to weather it. And I think that's been managed pretty well. I think the second thing is there's been a lot of worry about the loan portfolios, particularly commercial real estate. And I think we're beginning to recognize that for many of these regional and more specialist banks, their focus on commercial real estate is more in small cities around the country as opposed to New York or LA. So I think the markets are getting more comfortable that the crisis is behind us. But I do think that there's an opportunity for consolidation. The impact of regulatory capital, the impact of regulatory intrusion post-SVB is increasing costs. I think the higher interest rates for a while increase costs. So some of the very, very small regional and specialist banks, although very, very sound, are going to really struggle to get the ROE to appropriate levels. So we'll see some consolidation there.
Just quickly, language matters, investing versus buying. Would you be interested in taking over a regional bank in the United States of America?
As an investor, would I love that as opposed to an operator? We do think of ourselves not just as investors, but as operators. And so if we make a significant investment in an institution, a regional bank or Panmure Gordon, as you and I have talked about in the UK, staying as non-executive, staying as investors, we can still have a pretty positive impact on the growth. And that's how I look at it. Would I love to get really, really involved with a couple of regional banks? Absolutely.
Absolutely.
Yeah.
Where would they be? Have you identified one?
I can't say that.
I'm trying to get to it, Bob. We're trying to tease this out in this program.
Very good question, though.
Well, you've got a couple of minutes to chew over because you're going to be with us for the next hour. Bob Diamond is potentially looking at buying a regional bank in America, but can't say too much. Let's get you some headlines from stories elsewhere. Let's catch up with Danny Berger. Morning, Danny.
Good morning, John. Florida Governor Ron DeSantis has dropped out of the 2024 presidential race on Sunday. He's now endorsing Donald Trump. DeSantis' exit in the race is just 2 days before the New Hampshire primary. Former UN Ambassador Nikki Haley is now the second-place candidate. The latest Emerson College polling shows Trump leading New Hampshire with 50%. Haley is at 35%. China's imports of chip-making machines jumped last year. Firms ramped up investments in an attempt to get around U.S.-led efforts to hobble the nation's semiconductor industry. Imports of the machinery used to make computer chips rose 14% in 2023 to almost $40 billion. BlackRock, meanwhile, is looking to sell an office complex in Shanghai. It would be at about a 30% discount to its purchase price. Bloomberg learning that the asset manager wants to speed up the sale of Shanghai towers. Other institutional investors have been offloading offices as a weak economy and oversupply weigh on the Chinese commercial property sector. And that is your Bloomberg Brief. John.
Danny, thank you. Up next on the program, stocks at all-time highs.
If the Fed is not cutting rates because the economy remains strong, I think the U.S. equity market will be pretty much fine with that. If the Fed is cutting rates because the economy is very weak, well, that's a whole other story.
That's next on the program. You're watching Bloomberg Surveillance live from New York City this morning. Good morning.
later got asked to be the head of USAID.
I got that job when I was 36 years old.
36 years old. You're running USAID. How many employees does it have?
We had 11,000.
And did you feel qualified to run something that big?
I did until, the work started.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. New time starts Monday. The 2024 nominating contests are here, and the candidates are making their cases to New Hampshire voters ahead of the primary.
And we're off to New Hampshire.
Bloomberg is live in the ground, bringing you the fastest news.
Trump is leading by a long shot.
Insightful interviews.
These candidates are trying to target independent voters.
And the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
Coverage continues today, only on Bloomberg.
Live from New York City this morning. Good morning. The price action looks like this on the S&P 500, closing Friday at all-time highs. We had some weight to that rally, up by a third of 1% on the S&P. On the Savannahs this morning, equities at record highs.
If the Fed is not cutting rates because the economy remains strong, I think the U.S. equity market will be pretty much fine with that. If the Fed is cutting rates because the economy is very weak, well, that's a whole other story. At the end of the day, if the economy delivers, earnings deliver, markets can move a bit higher.
The market's already charging towards Wall Street's year-end targets. Oppenheimer's John Stolfus, the most bullish on the street, calling for 5,200 by year-end. Lisa, that's just 260 points from where the S&P closed on Friday.
All right, you give me a bull, I'll give you a bear. Mike Wilson, over the weekend, he was talking about why he doesn't have the same kind of conviction. He talked about sort of the fiction of the broadening out. He wrote, so far in 2024, the laggards of 2023 are back to lagging, and the winners are back to winning, NVIDIA. When in doubt, it pays to go with the highest probability winner. In this case, it's high-quality growth, really pushing back against this idea that the equal weight is going to somehow gain precedence, that it's all about AI and some of these names that continue to deliver some of the earnings.
The grind hard continues. With us around the table, Stuart Kaiser, head of US trading strategy over at Citi, alongside the brilliant Bob Diamond. Let's get straight into it, Stu. Good news is good news. You've talked about this for a long time. Is the news still good?
Yeah, I think the news is still good. I think the bar's a little bit higher, this year than it was last. If we were sitting here in, January 2023, it'd be a much different discussion in terms of where expectations were. So yeah, the data's coming in good. I think there's a few more blemishes on the data probably than we've seen in the last few months, and that's gotten people, a little bit cautious about it. But, I generally agree with that view, which is 2023 is the perfect test case for that logic, right? Which is you had called 100 basis points of cuts priced into the back half of 23. Data came in really strong. Those cuts got priced out. Equities did just fine. So I think that's your playbook, but the bar is higher than it was last year.
What do you make of Mike Wilson's pushback on this broadening out in the rally, this idea that equal weight can outperform, that some of the beaten up stocks can start to shine again? Do you buy into that?
Yeah, we do. We do like S&P equal weight. It's a little early in the year, I think, to call the end to a trade. And look, we haven't started earnings either. I mean, the view on broadening out from us is an earnings story. It's not necessarily a price action story. And the idea is you have broader earnings, and that allows broader participation in the markets. We've just kicked off earnings season, so I think we want to get through earnings before we're willing to kind of pull the plug on that one. But yeah, we do believe in the broadening out story.
And this is something that's going to be key as people wonder, when is Goldilocks, not Goldilocks? We were talking about Max Kettner earlier this morning, not buying it, saying things had run too fast. You point out that a notable slowing in U.S. labor data is the trigger for you. What does that mean? What's the trigger?
I mean, look, it's payrolls, it's claims, it's credit card spending. Those are the three things we're really focusing on. I think if you were to think, like soft landing, hard landing, your soft landing is payroll stay positive, unemployment stays below, let's say, 4.5. A harder landing is you're printing negative payrolls, which I think would be incredibly negative for markets, and you get that unemployment rate above 4.5. So as a quick and dirty, those are levels we're looking at. Frankly, though, I think if we start printing sub 100K jobs, the market's going to, have to obviously increase the probability of that downside tail, and it's going to start to trade that way.
Bob, how frustrating is this story for you? Trying to work out if good news is actually good news.
Well, you phrased it perfectly, and Stuart, I think this fits exactly what you're saying, is if we go back a year from today, I'll have these numbers not exact, I'm sure, but Fed funds are about 4%. And every analyst coming on here is saying we're going to have a recession. And actually, rates went up another 150 basis points, and the economy is stronger. Now we get to this year, and every analyst is saying we're going to have cut after cut after cut, And I just, I think we're back to that same position, which is, I think the consensus has got it wrong going into the first half of this year. I think expecting, multiple interest rate cuts in the first half, when our view, similar to Stewart's, is the economy has some momentum. We're looking at continued growth this year, and if we get an economy in the first half of the year greater than 1%, which is the consensus, and the Fed has cut rates and goosed that a bit, I think they're going to be in a difficult position. So I just don't think they're going to do it.
Stuart?
Yeah, I think that's right. I mean, the idea that they're going to cut in March obviously is starting to get, priced out a little bit. I think, our view on this would generally be the market is, A, taking lead from the Fed. The Fed's telling you they're going to cut, not hike next. And they're pricing probabilistic outcome into this. Just because, 6 cuts are priced, it doesn't mean the market necessarily expects 6. The market might expect 2 with, what if we have to get 8, because the economy is weakening significantly. So I think the amount of cuts priced in, it does look a little bit too aggressive, but it's the market saying you're done hiking, so the next move is a cut, and now we're just sort of probability adjusting how many cuts you're going to have to do and when. And, the market's going to have to digest that if it comes out.
We were just talking with Bob about all the regional banks that he's going to buy, and I'm curious, from your vantage point, if you're leaning into this idea that a lot of some of the beaten-up stocks, including regionals, can really shine this year.
Look, if I think all the way back to last March, our view on regionals was until private capital invests in these things without a government backstop, we're going to remain pretty cautious. So if he's the private capital, if he's putting money in without a government backstop, then I'm all in. I would say, look, we do believe in the broadening out. Regionals and small cap are, obviously you're going all the way to the edge on those ones. I think our view on regionals would be, if you get insurance cuts, regionals are going to absolutely rip, right? Because that means you've got strong growth, which the regionals want and need, and you're getting kind of relief on the rate side. So if you kind of thread that needle, I think, regionals play right into that. We're a little more cautious now. We're staying with equal weight S&P right now, and we've honestly had this pushback in conversation with clients. Why aren't you going all the way down to small cap? And look, small cap has a little more of that recession cyclical risk, a little more credit exposure, and a little more rates risk. And we feel like there's a big enough opportunity in the equal weight that you don't need to take that additional step. But look, if we get insurance cuts, regionals are really going to move, I think.
I do have to say, Bob, you've been really behind some pretty bold calls. Also, EU banks over U.S. banks, which has been basically sacrilege to even say. Why this year is finally the trade going to make sense?
Well, I think the way I'd say it, Lisa, apropos of what you said, is since 2008, when the U.S. had a TARP program, and Europe and the UK decided that biblical justice to destroy the banks was their mode, the U.S. banks have just ripped, and the European banks have really struggled. And I think for the first time, if I could say it differently, I'm less bearish on European banks relative to the U.S. banks for the first time. But Lisa, if you look at UBS and Santander, 2 banks as an example, and I'm not saying across the industry, they have return on equity or return on tangible equity above 15%. They're looking a lot more like U.S. banks. They have very strong leadership. They have very strong wealth platforms. They have investment banks that are quite profitable, not trying to be U.S. bulge bracket investment banks, but very similar to the way we built it at Barclays with Barclays Capital. So I think if you look at UBS and Santander, they're going to perform quite well relative to the U.S. banks. Part of that is the valuation spread. Part of it is they're really performing a lot more like U.S. banks. And Stuart, you will recognize this, I think. Rates are going to stay higher longer in Europe than the U.S. because the U.S. economy we're pretty positive on. We don't have that feeling on Europe. But I would say, secondly, the European banks capture that interest rate differential at a better level than the U.S. banks for all kinds of structural reasons. So I'm very much less bearish.
Interesting. Hey, Stuart, got to thank you. It's good to see you, buddy. As always, Stuart Kaiser there of Citi, alongside Bob Diamond. Bob Diamond sticking with us. Coming up on this program, more with the CEO of Atlas Merchants Capital from New York City this morning. Good morning.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
2 weeks of gains coming into Monday, 2 days of gains on the S&P 500, closing at all-time highs in Friday's session. Your equity market right now positive by 0.4%. On the Nasdaq 100, up by 0.75%. The Russell, the small caps participating as well, up by about 0.6 here. Lisa, as we turn our attention towards big cap tech over the next couple of weeks.
So can the broadening out continue? And this, to me, is really going to be key. Is people talk about where the profits are going to come from. If you take a look at the profitability of the Mag 7, it is shocking. They're expecting something like 40% increase in profits year over year. It's something insane. So can they continue to lead even as everything else lags behind?
That move in the equity market happening, though, even with these levels achieved in the bond market, the 2-year, the 10-year, the 30-year. We had last week on a 2-year a 24 basis point move higher. On the 10-year, up by 18. This morning, down just by about 3 on a 10-year to 4.09%. But equity performance was decent in the face of a Treasury market sell-off off the back of pretty solid data out of America last week, Bramo.
That's what everyone keeps saying. It matters why rates are going up. If they're going up because things look very good and it's a controlled kind of increase, it's not whipping around by 20 basis points every day or a couple hours, then a lot of people can lean into risk. And we keep hearing this, but there's got to be a break point, right? Where suddenly people have to reprice some of the valuations if yields get materially higher than where they are now.
That's the bond market. Let's just finish on foreign exchange and take a sneak peek of what's happening in FX with the euro against the dollar. Unchanged at 108.98. I think we can just call that 109.
So boring.
We've joked about how many times we've heard from Christine Lagarde, the ECB president. They just want to talk about the monetary policy. The pushback we saw politically from a central bank president last week against what was happening politically, not in Europe, but over in America potentially over the next 10 months, 11 months.
Talking about how it's going to be really negative for the Euro region if Donald Trump becomes the U.S. president again. There is this question of how much this is a policy issue that has to do with investing in Europe and right-sizing some of the technological investments, et cetera. But it does raise a question, right? How she's going to frame this in her press conference. Inevitably, someone's going to ask her, aside from rate cuts, what are you looking at, and how do you respond to potential policy uncertainty over in the U.S.?
She's going to push the politics to one side and say this is about monetary policy today. Can she get away with that on Thursday?
That's what I'm wondering.
I think it's going to be very difficult. I want to go back to how we started our week in Davos, Switzerland at the World Economic Forum. We started by talking about how broken the European model was, the dependence on energy from Russia, on growth from China, on defense from the United States. What was interesting about how the week progressed, we actually saw a lot of leaders come out. The Dutch Prime Minister with us in Davos, Switzerland, say that the former President Donald Trump was right on NATO. We heard from Emmanuel Macron, the French leader, AMH, who said that we need a sovereign Europe. I would say they're on board with the idea that things are broken. We've got to do something about it.
Yeah, and they're looking internally to the single market. Emmanuel Macron saying they need a sovereign Europe. He said this before, but it seemed like he's ratcheting up that concern if you're looking at potentially Trump back in the White House. And Christine Lagarde, for 1 week, talked about Trump with our Francine Lacroix. When Francine asked about it, she said, I'm going to need some coffee to talk about this. And then she ended her Davos week saying it's time for Europe to go on the attack to prepare for a second Trump term.
She's done it repeatedly over the last week. Let's get to some top stories. Under surveillance this morning, the race for the Republican nomination down to 2. Florida Governor Ron DeSantis ending his campaign for president and endorsing frontrunner Donald Trump. The news coming ahead of tomorrow's New Hampshire primary, with Trump now set to go head-to-head with Nikki Haley, AMH, as the last remaining GOP candidate.
Yeah, and he's pulling ahead in New Hampshire, and this was supposed to be the place that Nikki Haley could potentially break out. This CNN poll yesterday that dropped, he's at 50% in New Hampshire. So the question becomes, if she doesn't come close to that or win New Hampshire, when does Nikki Haley drop out?
When does the market care? Honestly, I mean, I keep wondering how people price this out, because honestly, what we heard from a whole host of executives was, we know what we're going to get from Joe Biden. The uncertainty is what we don't know from Donald Trump. But a lot of their trade policies are very similar, actually, ironically. And there's a real question about whether it will be basically the same on policies that are most important to markets.
Bob Diamond, the part of the program that you were looking forward to the most, politics. You've seen a few of these, haven't you? A few electoral cycles. How different is this one for you?
I think it's not that different when you step back and look at kind of how this election is playing out from an international perspective. So kind of apropos of what you were saying about Christine Lagarde or Macron, or the number of people that you would have seen in Davos last week, I think there is a surprise. It's like, are these really the two candidates? Is there no more change than this? And I think that's been fairly consistent over the last number of elections, where it's been kind of the standard bearers coming out. So I do think there's a disappointment, as not that that's the most important thing, but I do think that there's a negative surprise internationally to these are the two candidates.
How relevant is the political story to your investment decisions? You mentioned Europe versus the United States before the commercial break. How relevant is it now?
It's really interesting. The more you research the impact of elections on the markets, the more you realize there isn't one. And it's not very relevant, Jonathan. And I've been trained in that way by Larry Cantor, our strategist, and other people. As you just go back through the records, what's happening in the election does not have a big impact on the markets. And, what I'd like to believe is the markets are just discounting this before we start to consider it. So from our investment strategy, there's very little impact of what's happening in the election.
That's the domestic story. Let's talk about the international one. The White House warning Houthi attacks on ships in the Red Sea are unlikely to stop immediately, and hinting at more action to come. U.S. airstrikes destroying a Houthi anti-ship missile over the weekend in the latest efforts to stop the rebel attacks. President Biden's Deputy National Security Advisor telling ABC it will take time to play out, and they'll, quote, have more to say about it soon. Anne-Marie, can you try and make sense of the communication on this very issue from the administration over the last weekend?
I think you said it best earlier when you said that Biden was saying the quiet part out loud. The Houthis will not stop, but they will continue strikes. But the strikes are going after their material to strike the Red Sea. They're not actually going after leadership or something that could potentially put an end to this. So they're trying to degrade the Houthis' actions without spreading a wider conflict.
All I can say is, I don't know how much this has been priced into a lot of corporate earnings. And I really wonder if we start to hear about that on the earnings calls, this idea that the freedom of the sea is being challenged in a material way, that they're going to have to take longer routes, that's going to pack in some longer times for delivery as well as more gas. Honestly, this to me seems like it should be hitting things much more directly. Mike Wirth of Chevron pointing out that he's surprised that oil prices haven't responded more to this. And going forward, he's expecting, if there is some kind of increased altercation, prices to go back to $100 a barrel.
Torsten Slock of Apollo wrote about this over the weekend, the prospect of goods inflation returning. We'll catch up with Seth Carpenter of Morgan Stanley in the next hour to talk about some of these issues. I want to finish on this story. Macy's rejecting a $5.8 billion takeover from investors, claiming the offer lacked, quote, compelling value. The offer from Arkhouse and Brigade Capital, representing a roughly 19% premium to Macy's last closing price, but the retailer saying the investors failed to address concerns, Lisa, over their ability to finance the transaction.
This to me really highlights, if we get lower rates, do you get more M&A? I'm sort of backing into this. But if you take a step back, it's basically you can make highfalutin proposals. Where are you going to get the capital, especially given where prices are right now? And if you don't have that viability, why should you accept that kind of takeover if it could just basically drag you through the mud in some sort of saga, which we've seen so many times before?
So which one was it? Was it about the availability of the capital or the price they were offering?
I mean, right. At a certain point, it's probably the price, because it always comes down to price. But at the same time, if they're offering a price and they can't come through on it, then it's a wholesale disaster. Whether this is just not wanting to let go and not wanting to just cannibalize the real estate portfolio is another debate.
Bob, can we talk about capital availability? We've seen a lot of issuance in the credit market, backed up by a lot of demand to start 2024. How available is capital currently?
I think, as always, what I'm going to say is what you would expect is for the right idea, there's capital. We go back to the credit markets. I think the expectation, not that there's cuts necessarily, but that the Fed is finished, has created, a real opportunity for the issuance of credit.
Issuance through the roof, Bramo, over the last month or so, last few weeks.
It's been one of the busiest Januaries for more than a decade, I believe, as people try to come back and get their capital up to date. I do wonder whether this is people who have been holding off, who now have certainty that rates are going to be going down and they have certainty of their businesses, or if this is people who have been holding out for as long as they can and now they have to refinance. And I wonder if you get more of that down the line with companies with less secure business models, do you have a little bit more of a disruption because spreads are actually in, even with all this issuance?
We talked about that phrase last week in Davos, survive until 2025. The hope is that ultimately rates come down and when you need to issue, they'll be lower than they were in the last 12 months, but I guess we'll see.
I just am wondering how many zombies are going to come out of the woodwork. I mean, I know Tom with his zombie roll-up. There is this question of, okay, there are some companies that were sustained by zero rate policies, and you had 5% high yield bond yields, all in yields. Now you're looking at 10%. Is that viable for a lot of these companies? And the answer is going to be no. It's just that, okay, well, maybe they're not going to be 10% then. Maybe they'll be a lot lower. And I think, survive until 25 has continued to this day.
I do love that phrase, survive until 25. Bob Diamond's going to weigh in on that with Kelsey Barrow of JP Morgan in just a moment. Let's get you some of the headlines from stories elsewhere this morning. Let's cross over to Danny Berger. Morning, Danny.
Good morning, John. The Republican presidential primary is now down to two candidates. Florida Governor Ron DeSantis dropped out on Sunday, leaving Nikki Haley and Donald Trump to battle it out in New Hampshire tomorrow. DeSantis has endorsed the former president, who is the current frontrunner. Macy's is walking away from a $5.8 billion takeover bid. Investors Ark House Management and Brigade Capital Management had offered a deal that represents about a 19% premium to the close on Friday. Macy's board, though, declined to provide due diligence to Ark House and Brigade. Ark House says it is, quote, highly motivated to make a deal. And shares of Boeing drop in the pre-market trade as the FAA tells airlines to check parts of another 737 model produced by the manufacturer. The regulator recommended inspecting the same type of door plugs that failed on an Alaska Air flight earlier in the month. Boeing shares have fallen almost 14% since the mid-air blowout of a 737 MAX 9 door. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, the Fed remains patient.
When the time is right to begin lowering rates, I believe it can and should be lowered methodically and carefully.
That's next on the program. You're watching Bloomberg Surveillance.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
40s.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City this morning. Good morning to you all. Here's the price action on the S&P 500. All-time highs at a close on Friday. We add some weight to it this morning. This Monday morning positive by 0.4%. Under surveillance this morning, the Fed remains patient.
When the time is right to begin lowering rates, I believe it can and should be lowered methodically and carefully, with economic activity and labor markets in good shape and inflation coming down gradually to 2%. I see no reason to move as quickly or cut as rapidly as in the past.
That's the latest from Fed Governor Christopher Waller speaking to the Brookings Institute last week. Lisa, I did not hear the month of March from any Fed official over the last week.
They all tried to push back, and this whole idea that this time is going to look a little bit different just because inflation is structurally higher and there's no need to cut rates dramatically. Still, you're seeing buy the dip out there, and the dip being the bond market selling off. And we saw that from Matt Hornbach, who wrote in a paper over the weekend. He's the head of macro strategy at Morgan Stanley. This is the dip we have been looking to buy. With less fiscal support and much colder weather, we see downside risks to U.S. activity delivered in February. So blame the weather, blame the fact that you have perhaps less fiscal support, but maybe the data is going to turn according to him.
Kelsey Barrow with us around the table, fixed income portfolio manager at JP Morgan Asset Management. Kelsey, good morning.
Good morning.
The perceived gap between the Federal Reserve and markets, are we closing that gap with the market coming up to the Fed, or do you see the Fed coming down to the market sometime soon?
So we are closing that gap, but I would say I don't really view the gap as that wide, right? So Waller was maybe pushing back on the timing, but I think what he was mainly pushing back on is this idea of very aggressive cuts. So if you remember on the way up, we were hiking 75 basis points a clip. I think what he was trying to push back on is on the way down, this is going to be much more gradual and methodical. Don't expect us to be cutting as fast as we were hiking because we're not in an emergency environment. We're in an environment where the labor market is still healthy, inflation is coming down. That justifies cuts. Pretty much everyone on the FOMC, if you look back at the dot plot, only 2 showed the Fed funds rate unchanged by the end of the year. So everyone's in consensus there. It's really about the speed. So I actually don't see a huge gap between the market and what the Fed ultimately wants to do.
So 6 rate cuts this year you think is plausible with the rhetoric that we've heard from the Fed?
It is still plausible. I mean, there's only a certain number of meetings in the year. So as you push back on March, that is one less meeting that can be achieved. But I look at the path of the Fed funds rate, not just over the calendar year of 2024, because I think we get a little obsessed with these calendar years. And I look at where is the Fed funds rate troughing at? It's troughing at 3.3%. That's the bottom in which the market is pricing the Fed funds rate to get to. That's a reasonable easing cycle. It's not an overly aggressive easing cycle. It's an easing cycle I think is still consistent with soft landing pricing.
What I'm struggling with is there is an inconsistency with this idea of rate cuts, aggressive or not, gradual, sure, but rate cuts that deep with an economy that's moving as robustly as we keep hearing. Is that dissonant for you, or does that make sense?
So I think that the economy does need to moderate for the Fed to continue to have confidence that inflation is going to be sustainably at 2%. So, you know, this isn't supposed to be a situation where inflation touches down to 2% and takes back off. This needs to be an extended stay at 2%. And the way that they get confidence in that is if the labor market cools enough. But I do think under the surface, the labor market is cooling. So, for instance, if you take a look at private payrolls and you strip out government hiring, which tends to accelerate in the late cycle, which is something we've seen time and time again, and you take out education and healthcare, we're actually grinding down to nearly 0 on private payrolls growth when you exclude those categories. So I think things are softening, but we do need to be cognizant of that. The fact that the Fed is considering rate cuts does introduce a new tail risk that we weren't thinking about in 2023, which is the reacceleration risk. And we are cognizant of that.
Jobless claims 187. What are claims doing falling if things are slowing and getting weaker?
Right. Well, there's two different pieces of the labor market puzzle, right? You have layoffs, which are still low, but you have hiring, which is slowing. And I think that makes sense. Just think about companies, right? How do they behave when demand is moderating? They don't immediately fire everyone. They first start by looking to cut back people's hours, which you have seen. And then also, maybe they don't need to raise wages as much as they did. And then firing, they are going to be more hesitant to do that, particularly based on how hard it was to find those people in the first place. So yes, there's a little bit of dissonance there. There are a lot of data points that are kind of sporadic right now, which I think is indicative of kind of an inflection point. I think you do see more data pointing in different directions when you're at a turning point in the economy. So baseline, I think you still need the economy to cool to get the Fed to cut, but that is our expectation.
Well, this is a question for business operators. The decision that they've got to make ultimately to perhaps hoard talent. Do you think this labour market, this cycle that we're starting to see emerge, is going to be different to what we've seen in cycles gone by?
Yeah, I think Kelsey's point, which is that over the last couple of years, I think hiring talent has been more challenging than it has normally been. People aren't going to forget that immediately. So I think I wouldn't have thought hoarding talent would be the way, but I do think cutting talented people would be very, very challenging. I don't think the environment's calling for it yet, neither does Kelsey, but I do think people will recall that we've been through probably the most challenging market for hiring talent since COVID began that I've seen in my career.
So I'm wondering what you think of what Kelsey was talking about, given the fact that you see only 2 rate cuts this year maximum, and think that the Fed doesn't have the room to cut rates very aggressively. Where do you diverge from what Kelsey is saying?
I think we're both saying the Fed will be data dependent still, and that they haven't made their decision. I think where we would agree, I would say, Kelsey, is that we've seen the peak. I would bring up 2 things in terms of why I'm probably a little bit more cautious, but directionally we're kind of the same. One, while monetary policy has been tight, fiscal policy is getting loose again. We have $2 trillion coming out in spending for infrastructure, and I haven't heard anyone talk about that. So I think that's one thing. And 2, I believe strongly that the Fed has to be very, very conscious of getting ahead of this. If they cut rates once or twice and there's an acceleration in inflation and they have to reverse course, I just think that's the worst position for the Fed. On the other hand, if the economy begins slowing because they haven't cut rates and then they cut because the economy is slowing, it's exactly the plan that they want. So I think they're going to be extremely cautious. The last thing I'd say is I'm a bit of a historian. I mentioned the work I do with our operating partner, Larry Cantor, earlier. He worked with the Fed for many years. And if you go back through history of the Fed, the bar for reversing course is very, very high. So there's no question there's a pause. There's no question their intention is to not raise rates anymore. But the actual bar for reversal, because of the signal with reversal, is very high. I think they're going to be really cautious. And my sense is it's going to be second half.
There's a lot to unpack there. I want to focus on the fiscal actually for a minute, because there are $162 billion of auctions just this week alone. 2-year notes tomorrow, 5-year notes Wednesday, $41 billion of 7-year notes on Thursday. Kelsey, when do people start to care about the deficit again? Are we one bad auction away from sort of this premium baked into valuations?
Well, I don't think this is the week, maybe famous last words, but I do think that we're in an environment where, there is demand that's meeting this supply. It's not just in treasuries. We've had a tremendous few weeks in investment grade credit. For example, I think just to speak to the amount of the way that sentiment has shifted over the last 12 months, you think about the regional banks and the issuance that they've done over the past week. These are, banks that wouldn't have been able to issue last spring, and you wouldn't have been able to sell the paper even if you tried. And now they're issuing with little concession and, multiple times oversubscribed on the books. So it's been a really large sentiment shift, and I don't expect that to change anytime soon. But just getting back to this idea of where this risk that the Fed may be more cautious and more gradual. I actually think that that's not a bad environment for fixed income investors, because while we're waiting for them to decide when the first cut is going to come, you can collect that carry. But then in the event that the economy does slow down more, the Fed has more policy space than they've had in a very long time. You think about how much they cut during COVID. They cut 200 basis points because that's the only space they had. They were at 2 3/8, and they had to cut to 0. Now they have a lot of policy space. They have a lot of ammunition to help the economy if things do slow. So risk reward for fixed income investors, really good here.
You talked about the potential of going back to, say, 330 on Fed funds. What are you thinking about the longer end of the curve? Because presumably what I'm hearing from you is investment risk, whether you're looking at T-bills maturing and reinvesting that capital. You don't want to miss out on this move further out the curve. If yields are at, what, 4% now, you risk them dropping to, what, 3.5?
Yeah, I think that's reasonable. So typically what happens with the shape of the yield curve is ultimately most of the volatility in the yield curve is going to be driven by the front end. So it's the story over longer periods of time is that as the Fed is cutting rates, you see the curve. As the Fed is hiking rates, you see the curve flattening. As the Fed is cutting rates, you see the curve steepening, right? So we're entering a period where the Fed's on pause. The next move is going to be a cut. Ultimately, in that environment, the curve is going to be steeper. In the very short term, as March is being priced out in terms of the market probability, I think you could actually see a little bit of tactical flattening. But that's very much on the margin. In general, big picture, over cycles, if the Fed is cutting rates, you're seeing the curve steepen.
Are you more bullish right now on treasuries than you are on corporate credit?
That's a tough one, but I would say we're actually feeling very good about corporate credit as well, as particularly investment grade and high quality, because again, that risk reward we see is very favorable. The technicals are a big part of that market, and we're seeing quite a lot of demand come in. I think there were a lot of people who were concerned in November and December that they missed the rally. So if you look at how much the U.S. aggregate was up in November and December, it was about 8%, which is absolutely massive. And there were a lot of people asking the question, did they miss it? And I think the point is, any of these backups is really an opportunity for those people to get invested, lock in yields that you really haven't been able to achieve in a high-quality fixed income portfolio in multiple decades.
Kelsey, this was great. Kelsey Barrow there of JP Morgan Asset Management, alongside the brilliant Bob Diamond of Atlas Merchant Capital. You heard that one, Bramo. Lock it in. I've heard that so much over the last 6 months.
Yeah, although if you're locking it in right now, we're looking at spreads on investment grade credit that are the lowest going back to February 2022. So I don't know if you've missed it, but the idea of selling it off, I mean, this is such a confusing market. This is not what we normally expect with credit spreads coming in.
What does Steve Major say over at HSBC? And we've talked about this lots. The demand now at 4 is greater than the demand existed when we were at 5. Yeah, it's just the way markets work.
Yeah, when something's on sale, you don't want it. Yeah, exactly. Yeah. When it's really expensive.
The price starts climbing.
You just
go
all in.
It. No, I know. It's the psychology of things. Bob, it's good to see you. Thank you, sir. Coming up on this program, Alicia Levine of BNY Mellon, Seth Carpenter of Morgan Stanley. Plus, we'll catch up with Katie Ledines on the latest in Washington, D.C. From New York City this morning. Good morning.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology. the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well? Or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
We are very pleased what's happening with automotive. We're now working with virtually every car company.
The innovation from our new products and services, that's really what will drive us forward.
We have better jobs, we have better national security, better economic, and we're ready for a turbulent world.
Travel is doing very well. Entertainment is doing very well. Wellness products are doing very well.
I think you're going to see the banks do really, really well, and they're going to be a wonderful performing asset in 2024.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market at all-time highs on Friday. Your equity market this morning adding some weight to that rally, positive by 0.4%. Lisa said it last week, the difference between doers and thinkers in Davos, Switzerland.
The doers are saying, let's go. Really well, really good. You just heard that in all of the interviews that we did in terms of this optimism. And then you talk to the thinkers and they say, well, what about the Houthis? And what about the Middle East? And what about the election cycle? And what about the potential for some kind of slowdown? And why are you guys so optimistic? And I kind of understand the thinkers, but the doers are giving a very different story out there right now.
The President of the United States hoping the former are right and the latter are wrong.
Yeah, absolutely, because the risks right now are concerning for them, given the fact that when you look at what people care about, it's the economy. And people are actually starting to feel better about it. That's what we saw on Friday. People are starting to feel better about the economy. Inflation is coming down. Is the timeline on their side? But could something like what is going on in the Red Sea upend all of that, especially when it comes to inflation?
We often ask this question. On your dashboard right now, what's your North Star? What's guiding you? Which economic data point? If you wanted to pick one from the last 12 months, it might be jobless claims. Jobless claims dropping last week. Lisa, they stand out to me, not retail sales, jobless claims back at 187K.
And we talked to the executive of Manpower Group, which is the biggest staffing firm globally, and they're saying the same thing, that people are able to get hired. So if the labor market is good, and we were just talking to Stuart Kaiser, that's his lodestar, then what's exactly going to cause things to turn the other way? The kicker, though, is if that's the case, why should the Fed cut so aggressively, and has that fully been priced into the market?
Stuart's been clear. Good news is good news, and based on the communication we've had from the Federal Reserve in the last week, that's been reinforced by the economic data. Let's get to the price action right now, positive by 0.4% on the S&P 500. In the bond market, yields just a little bit lower, down about 3 basis points, Lisa. Let's call it 4.1% on a 10-year.
And really, to me, the big test is going to be on Friday. We get core PCE, that key inflation metric that the Fed looks at. If you see it come in as aggressively as some people are expecting, it's supposed to maybe stay in line, then do you get a sort of leaning into this Goldilocks that everyone's been playing into, and it starts to broaden out beyond just NVIDIA, which is up 20%.
And that's the market with a big move on NVIDIA. Coming up on this program, about 90 minutes away until the opening bell, with stocks sitting at all-time highs. We talked lots about the financials in the last couple of weeks. Wall Street is done. We'll talk more about big tech in the weeks to come. Microsoft next week, Apple the following week in early February. Then we've got to talk about the president. President Biden getting his wish, consumer confidence beginning to bounce. Did Nikki Haley and Marie get her wish over the weekend?
It really depends on where this 5% that DeSantis was polling in New Hampshire go. Do they go to Trump or they go to Nikki Haley? But I think he did her a favor by dropping out before, because at least it gives her that opportunity to get some of those DeSantis votes, given the fact that if you look at the polling over the weekend, it is Trump's to lose. He's at 50% now to her 30-something.
I'm sick of talking about this election that's just starting, and we heard from Bob Diamond this idea that
it's January.
It's January, but this is what he said too. He said that there's a little bit of disappointment just in general that these are the two candidates, and that maybe that's the risk that people are kind of leaning into right now.
You've heard a lot of people say it. Could we have done better than this?
I know.
That's you see it in the polls. You've seen it in the polls repeatedly.
It's the election. It's the election Americans don't want. They don't want this rematch, but it's the election they're going to get.
Which begs the question: what's turnout going to be like at this election, given that there is basically no enthusiasm to end up with these two candidates?
Especially in the groups that the Biden administration is going after. The youth that came out for him, will they come out for him this time around? That's going to be a huge issue for them in places like Wisconsin and Michigan.
Katie Lyons down in Washington joining us in just a moment. We need to talk about this as well. Rejecting a $5.8 billion takeover. Macy's, Bramo, is pushing back and pushing back hard.
You raised this question. Is it because of valuation, it's a 19% premium, or is it because of questions around financing? The issue with Macy's is it has a lot of hope that it can rejigger itself as some sort of juggernaut of the shopping retail experience, but other people are saying it's just a real estate shop, that essentially they just need to sell their businesses. So at what point do they start to have some real questions about their potential valuation versus their existing valuation right now?
Is it about the valuation or about the availability of capital? We talked about that briefly.
Yeah.
Sounds like the latter, not the former.
Well, I was about to say, I have a feeling I know where you stand on that. Like, isn't it about valuation?
No,
though?
I just mean, like, I mean, why would you bring up the availability of the capital if you were unhappy with the price? You just wouldn't talk about it, would you?
Okay, right. Although if you want to discredit them in a more significant way, while also continuing to open the door to other bids. It's like we're not for sale. It's just that we want a better sale from someone who's a little bit better.
And might have the actual money to follow through. Sure. Okay. I think we agree.
I think so too.
All right. Let's begin with our top story. Stocks sitting at all-time highs, but Alicia Levine of BNY Mellon Wealth Management seeing a bump in the road, writing this. The equity market struggles in the first half and gets stronger into year-end. This is consistent with the business cycle of possible slowdown in the first half and the typical cycle in an election year where it's hard to have a recession. Alicia Levine joins us now for more. Alicia, good morning.
Good morning.
Got to get to the election piece of that. Why is it hard to have a recession in an election year?
We had news in the last 3 days that tells you there's going to be another fiscal bill, right? So the administration in a re-election year has tools in its tool case to really steady the economy if there's any slowdown. And so what Biden's going after the consumer, the tax credit to consumers, the financial modeling and gap in taking some of those tax cuts from Trump that were going to expire, bringing it back, 100% expensing. So what we see is $100 billion coming out of the gate in fiscal that's going to steady the corporate sector and the household sector. And then 2024 is the year that $2 trillion of stimulus that was passed in the last couple of years for the IRA, the CHIPS Act, and the infrastructure bill is going to come on board. So you're starting to see the money pumping from Washington again, even though we thought it was all over, and it's not all over.
So this really begs the question, just on the bond side of things, isn't this going to blow out the bond market if fiscal support actually accelerates, not declines, as so many people are expecting?
So that's a really interesting question. I think what's going to also happen this year is that you're going to have better tax receipts because of the stock market and because of corporate profitability last year. And so come April and come the quarterly tax season, you're going to see greater receipts than last year, okay, which is going to steady the deficit. And once that happens, that will steady the bond market. So that risk, yes, overall, like why are we doing more fiscal? The fiscal's already been spent, right? It's already been spent, but we're getting more in tax receipts. And so that's going to help steady the issuance.
We heard a little bit about this from Bob Diamond in the last hour, this concern about fiscal deficits. He's saying that it's not going to be an issue for the market this year, but will be next year. At what point people start to get actually concerned about the U.S. financial health?
So people will start getting concerned about it after the election year. Nobody, like, you know, neither the challenger or the incumbent cares about the fiscal health of the U.S. while they're running, right? Because in the end, politicians were put on earth to give away things and not take them away. And that hasn't happened in a really long time. If you go back to the end of the Berlin Wall, right? Go back over the last 30 years or so, every administration, whether Democrat or Republican, cut taxes, okay, and did fiscal spend. So the opposite, which you would expect to happen, is really painful. Nobody remembers what it's like to have austerity, and neither of them is running on it. So if it's going to happen, it's going to have to be the bond market saying it. It's going to have to be Congress saying it. It's going to be the other side of the election. So 2025, you could have the conversation.
The bond market whispered it in October, I guess, and then took it back pretty quickly for like a month or something like that. Alicia, we're talking exclusively about the United States.
Correct.
Europe's struggling. China, the data out of China is still pretty dreadful. Are we basically firing on one engine at the moment in the global economy?
It looks that way, and it looks like it could be that way, because what's going on in the Red Sea is actually more of a risk to Europe than it is to the U.S. So oil and gas prices and just the proximity creates an inflation risk for Europe in a way that just doesn't here. We're just not as levered to that problem. And then China, as we know, simply can't get out of its own way. I mean, it's really the third year that the market is terrible there. It's the sentiment is so bad, I would have to expect that there's an opportunity somewhere, but we pulled our clients out of China because we just think it's not a place that you can, as a fiduciary, that you can put client capital.
You think it's uninvestable?
Essentially.
For the time being, what would you look to change that ultimately?
I think the corporate governance. I mean, you know, in the end, you don't own shares of corporate China. You don't own it. In the end, you know, the political party is sitting at the top of the corporate structure of every large company and small company in China. Very hard to invest that way. So, you know, if you're a fiduciary, as we are, that's just not something that we can model or that we can risk out.
Every time
but
this
we
comes
like
out,
emerging markets. I just wouldn't be.
Can you strip out China from EM? What does that even look like?
You could. I mean, in the end, if you look at who gains if China fails, well, you've got Vietnam and you've got Mexico and you have India. So you can, and in fact, China's loss are those countries' gains.
Although at this point, are you betting on some sort of ongoing economic malaise that could have some sort of trigger, or just you can't invest there because you don't know what the rules are going to be? Is there a distinction?
Yeah, so it's a good question. Am I worried about the fundamentals in China, or am I worried about that as an investor class we're not protected there? It's both, but the fundamentals don't look great. And let me just say one thing.
Sure.
When you think about GDP growth in China since the WTO, right, it was extraordinary. Think about compounding GDP growth in China, and yet you made zero investing in China. So when China slows down, why do you think you're going to make money in China? If you couldn't make money in China when it was growing 8, 7, 6%, you're not going to make money in China if it was growing 4 and 5%. It's actually extraordinary looking at the charts. You've made no money in China since the WTO.
No, we're totally sport in the United States. We're conditioned to believe that stocks only do one thing, they go up and to the right. Everywhere else, lost decades. Look across the board, Japan, Hong Kong, China. The experience in China has been absolutely dreadful in equity markets.
Although it hasn't necessarily come because of growth. It's come as a result of certain policies and a lack of predictability. And that's the unique feature. At this point, though, how do you game out the global economic consequence of a slower China that doesn't have the levers to pull to attract that foreign investment in the same kind of way? I don't really know the answer.
Alicia, this is great. You're going to stick with us, I'm pleased to say. Alicia Levine of BNY Mellon. Let's get you some of the headlines from stories elsewhere this morning. We can say good morning to Danny Berger. Morning, Danny.
Good morning, John. Florida Governor Ron DeSantis has dropped out of the presidential race and has endorsed the former president. The GOP nomination is now down to 2 candidates, with Donald Trump front-running Nikki Haley. Voters head to the polls tomorrow for the New Hampshire primary. ADM is placing its CFO on leave and cutting its earning outlook. That's pending an investigation into the agricultural trading giant's accounting practices. The probe is in a response to a voluntary document request by the SEC. Shares of ADM are dropping in the pre-market trade. And shares of Boeing are extending declines in the pre-market trade as the FAA tells airlines to check parts of another 737 model. The regulator recommended inspecting the door plugs that failed on an Alaskan Airlines flight earlier this month. Boeing shares have fallen almost 14% since the mid-air blowout of a 737 MAX 9 door. And that's your Bloomberg Brief. John.
Danny, thanks for the update. Appreciate it. Up next on the program, the GOP field is narrowing.
I am today suspending my campaign. I'm proud to have delivered on 100% of my promises, and I will not stop now.
Live from New York City, that conversation is coming up next. From New York this morning, good morning. You're watching Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The 2024 nominating contests are here, and the candidates are making their cases to New Hampshire voters ahead of the primary.
And we're off to New Hampshire.
Bloomberg is live in the ground, bringing you the fastest news,
Trump is leading by a long shot,
insightful interviews,
These candidates are trying to target independent voters,
and the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
Coverage continues today, only on Bloomberg.
Live from New York City, a little more than 60 minutes until the opening bell in New York on Wall Street. Equity futures shaping up as follows on the S&P 500. Adding some weight to the all-time high that we saw at the close on Friday. We're up by 0.4% on the S&P. Under surveillance this morning, DeSantis is out. The GOP field is narrowing.
I am today suspending my campaign. I'm proud to have delivered on 100% of my promises, and I will not stop now. It's clear to me that a majority of Republican primary voters want to give Donald Trump another chance. I signed a pledge to support the Republican nominee, and I will honor that pledge. He has my endorsement because we can't go back to the old Republican guard of yesteryear.
Ron DeSantis dropping out of the presidential race, throwing his support behind Donald Trump, just days ahead of the New Hampshire primary, where the latest polls show the former president widening his lead over Nikki Haley. Trump welcoming the endorsement from the Florida governor. Anne-Marie saying this: "I look forward to working with Ron." That is a change of tone in the last 24 hours.
Oh, not just that and a change of tone. He also said he's going to be retiring his nicknames for the governor of Florida, especially since he's been calling him Ron DeSanctimonious. He says that's over now that he's come out and endorsed me. Jonathan, a scathing opinion piece this morning from Politico. They weigh in saying, quote, "Perhaps Trump's vast lead could not be overcome, and this was the wrong cycle for DeSantis to run. Perhaps for someone so uncomfortable with people,
that's brutal.
This was the wrong decade or century. Still, that's no excuse for misspending over $130 million and running the worst presidential campaign in history." And I got to be honest with you, read the whole piece. This is actually some of the least scathing bit of this piece from Politico, just absolutely dumping on DeSantis' campaign and how it was run.
It didn't start well, did it?
No, this idea of failure to launch. I mean, talking about this idea with this Twitter or X
They thought it was going to be edgy.
They thought it was going to be edgy. It just failed. And then he was talking about how they broke the internet, and they said, no, it just failed. And that was sort of a question. And it sort of highlighted the underpinnings of the campaign. I will just say at this point, big question about where that support goes. Does that help Nikki Haley? This is what Nikki Haley's wanted all along. Has it come too late? Is it enough?
Let's talk about that right now with Bloomberg's Katie Lyons, live from New Hampshire. Katie, walk us through how different New Hampshire will be versus Iowa just a week ago.
Well, in some ways, John, New Hampshire won't be drastically different for DeSantis no longer being in the race. He was polling in low single digits here, roughly 6% in the latest polls that we had been seeing. So his departure may help perhaps Trump on the margin, but still it largely is the two-person race that Nikki Haley was painting it a picture of as we emerged from Iowa. But in terms of actually how New Hampshire is different than Iowa, demographics are a huge part of it. Iowa obviously has a strong conservative base, a lot of evangelicals in the first-in-the-nation caucus state. Those lended their support more to Trump. Nikki Haley really struggled to get those voters. What she's going to try to do here in New Hampshire is capture all of the independents, more moderate Republicans that she is trying to cater to. That's what New Hampshire is known for, but at this point, polling is suggesting that that just might not be enough. In the latest Suffolk University Boston Globe poll that came out this morning, she is behind Trump by 19 points, and the enthusiasm gap between these two candidates is still very wide, just as it was in Iowa.
And Kayleigh, she has the support of the governor there, who's very popular for a Republican in this state. I think about what his father used to say, which is Iowa picks corn, New Hampshire picks president. But it looks like when you look at the polls, he backed the wrong person to be the next potential president.
Yeah, Governor Chris Sununu obviously is very popular in New Hampshire, and he is still standing by Nikki Haley as a candidate. He is not a Trump Republican, even though he has said he would support him if Trump ultimately becomes the Republican nominee. He does not think that he holds Republican values, and he thinks Nikki Haley still could have a chance. That said, he and even Nikki Haley herself are starting to set the bar lower for her as we actually approach primary day tomorrow. He's suggesting that a strong second place showing, something better than Iowa, will be enough momentum to carry her forward in this race towards South Carolina, for example, which, yes, is her home state where she served as governor, yet she is still polling even farther below him there than she is here in New Hampshire. But he stressed to Joe Matthew and I when we spoke to him yesterday that New Hampshire is not a must-win state. None of the early states really are. It's until Super Tuesday that she's going to have to start winning in some of those states come early March. But he also talked about the economy. I asked him, you know, we have a stock market at the record high. We have unemployment still below 4%. The labor market's hanging in there. Inflation is down. Is this not something that any future president, perhaps a future President Haley, would want to emulate when he was criticizing the Biden administration? And this is what he told me in response.
Let's look at national credit card debt. Let's look at what everybody owes, right? The spending that has gone on, not just with the government, but now with personal spending, and the fact that inflation is crushing folks. And this whole idea that the Fed is coming out and going to lower rates, I'm telling you, the piper has to be paid at some point. I think we are in store for an economic downturn.
And we know, just as in Iowa, the economy is top of mind for voters, but so too is immigration, the issue of the border. And Nikki Haley essentially is suggesting that she will be able to do what President Trump could not during his first term, which is actually secure the border, do things like finish the border wall. The governor told us that the difference between Haley and Trump isn't necessarily on policy, but the ability to execute on that policy.
So, Kayla, the big question going into tomorrow is, where does the DeSantis votes go, though? Does she pick any of them up? But I guess you have to think it's only 5%, so it's still a long shot for her if you look at the polls.
Yeah, exactly. He just wasn't a significant factor in New Hampshire, nor was Vivek Ramaswamy, who also dropped out of the race and endorsed Trump after Iowa. It does seem, though, that probably by and large more DeSantis votes would go to the former president than they would to Nikki Haley. But the gap that she is currently facing, at least if polling is correct, is just so large that even those marginal DeSantis votes aren't necessarily going to make a difference. So it really becomes a question of what exactly Haley and the campaign define a strong second as. If you are coming in double digits below the former president in New Hampshire, again, a state with those moderate and independent voters that you are trying to attract, is that really a mandate to continue the campaign forward another 4 weeks to South Carolina? That primary, of course, is on February 24th. Yes, the Haley campaign has resources. She is backed by Americans for Prosperity Action, the Koch super PAC. And yet, as we've seen with Ron DeSantis, it feels that a lot more individuals, including those who are also running against Trump in this campaign, are just falling in line behind him. And I was at an event last night with many Republican strategists who have been involved in these primary campaigns in past cycles, all of them kind of just stressing that there is an inevitability here that Trump is going to be the nominee.
Kaylee, great update. Appreciate it. Kenny Lyons there in New Hampshire. More from Kenny through the next 24 hours on the ground in New Hampshire. With us around a table here in New York, Alicia Levine of BNY Mellon. Alicia, let's finish on the politics if we can. We talked about this last week on this program. The candidate Trump, President Trump, comes with a lot of volatility. But this market, at one point, in late 2016, overnight when the results were coming through, started to focus on the policy and not the man. When you think about the policy of what could come, when do we start focusing on that in the next 9, 10, 11 months?
Look, usually it happens around August. August, September is when you start seeing a very clear bifurcation in different sectors over the polling of who could win. So that's really when you're going to see it. And like healthcare, for instance, is the sector that you would see it most. So if Biden looks like he can pull it out, you'd expect weaker healthcare. If it's Trump, less of an issue for healthcare. I mean, still not the favorite. You know, the pharmaceutical industry is not the favorite of either party, but still worse under the Democrats. Tech probably does better under the Republicans, because I would bet the FTC challenge goes away also. So, you know, the Republicans just aren't really good at regulating, right? Their hearts aren't in it. And so I would just say there's less of a regulatory problem for large cap tech under Republicans than Democrats. And I'd also say energy is pretty clear also. I mean, look how poorly the energy sector did under the first Trump administration compared to every other sector. So
at a certain point, you travel all around the world talking to clients, international clients. What are they asking about how you're going to respond to the presidential election? Do they care about it? Does it come up in conversations?
They seem to care more than we do. Because what investors in America understand is that investing based on your politics is a loser, right? Right. If you look out 1, 2, 3, 5 years, whatever your political stance, who's ever in office, the stock market, as you said, John, is up and to the right.
Yeah.
Okay, 6 out of 7 years. So the Europeans worry more, they condemn us more, but ultimately the American investor base knows that this is the place where capital is treated the best, and we are here to invest, and that's what we do. And we're doers and not thinkers. We think, but then we do.
You point to me. The Inflation Reduction Act, though, wasn't welcomed in Europe, and I had Europeans say to me, it's just better bedside manner, but a lot of the policies were the same, whether it's Trump or Biden.
Here, I think is what a lot of people said about capital being treated better here in the United States. Alicia, that was great. Appreciate it.
Thank you.
It's good to see you. Alicia Levine of BNY Mellon Wealth Management. Mark Dow. I always remember what Mark Dow says. I repeat it all the time. He said back in 2016, the challenge for investors, divorce your political bias from your economic analysis. And for the next 4 years, everyone struggled to do it. Seth Carpenter of Morgan Stanley is going to join us next. Live from New York City, this is Bloomberg.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
60 minutes away from the opening bell, equity futures look like this on the S&P 500, pushing higher once again on a two-day winning streak as we close out Friday. 2 weeks of gains at record highs. We had some more weight to those all-time highs, up by 0.4% on the S&P, on the NASDAQ, up by 0.7%, up by 0.75% on a Russell. The small caps pushing higher as well. In the bond market, 2-year, 10-year, 30-year, 2-year up by something like 24 basis points last week. Your yield, 437.62, down by not even a basis point. The data supportive of higher yields. Just go through it all. Clean sweep, Lisa. Retail sales, jobless claims, consumer confidence right across the board looking strong.
And it seemed to really edify this idea of a soft landing, because not only was consumer confidence the strongest going back more than a year, but you also saw the expectation for inflation coming down. So there's this idea the Fed can land this, and it's great for risk assets.
Want to finish on foreign exchange. The euro right now just south of 109 at 108.88. That currency pair negative by about 0.1%. Amazing to hear from Alicia Levine of BNY Mellon. And if you missed it, I'll try and paraphrase. Basically, in Europe, they're more concerned about the politics in the United States than investors in the United States should be, because capital, if you look at worldwide, capital is treated better in America than anywhere else. And for that matter, she is bullish US equities versus everything else.
It was funny because she was talking about all of her conversations internationally, and she just kept saying, they're more worried than we are. We're looking at it and understanding that all the noise can really come down to markets go up, and that's what they're betting on.
We heard this again and again in Davos, Switzerland. Political risks and rate cut expectations taking center stage at the World Economic Forum. Investors, CEOs, and government officials joined us to weigh in. Live from Davos, Switzerland for our audience worldwide. Good afternoon. Good afternoon.
Everyone's just focusing on Donald Trump. Everyone is talking about it behind the scenes. No one really wants to talk about it when you get them.
It's the elephant in the room, or the Swiss Alps.
Everything changes if Trump wins, in mostly for bad ways.
If Trump wins New Hampshire, is that a time when you're going to say, okay, I'm ready to endorse him?
I think it depends on kind of what happens, you know, how big a win it is, if that happens, if somebody else wins, what happens. I mean, I wouldn't want to speculate on that.
I will campaign for President Biden. I will certainly, because the stakes could not be higher for our country, for the world.
The economy is the #1 issue, John, when it comes to American voters.
Our camp is that we still see a recession coming, and although our base case is a mild recession.
Everyone's expecting the Fed to cut rates, possibly, if you believe the market, 6 times this year.
The 6 rate cuts, that's a pipe dream if we have a soft landing.
The market is now calling for a 175 basis point cut by the Fed. Really? How about this? No way. No way at all.
I think one of the risks is that the market is pricing in some aggressive rate cuts. The real risk is probably geopolitical.
Early October, your world changed. Can you tell me what it's like now, what's changed for you? as a governor overseeing a wartime economy.
Going forward, it's going to be very cautious, very moderate.
I think it's absolutely vital that we send a very clear and unequivocal message to Iran. This behavior is unacceptable.
That's an important part of the world for oil supply, and traditionally, when risks elevate in the Middle East, you see it reflected in markets. We've not really seen that yet.
Ukraine's just not on the front page anymore, particularly after the tragic events that took place in early October.
President Zelensky is here, and he's really trying to rally the West once again as they go into 2024 without the money they need to continue fighting Russia.
Even just the defense spending of the United States and the sum of money allocated to Ukraine, it's to say the least, a very little part of the overall defense spending.
Since 2014, allies have increased the defense spending substantially, but after the full-fledged invasion in 2022, of course, they started to do even more.
This was exactly Trump's main issue, that we were not spending enough, and he was right.
Macron said that 2024, 2025 is all going to be about how Europe can be more sovereign, whether it's AI, whether it's investment.
What proportion of some of these AI companies and initiatives do you think are actually going to come to fruition and be valuable?
The technology still has a ways to come, but I think it'll be just as revolutionary as the internet was.
I think it would be a terrible shame to throw away the most powerful tool we have for producing a productivity surge and growth.
AI, if it's going to transform our working lives, do you think we're just more productive but do even more?
They used to have to get up at 4 a.m. in order to write the report. Now they can get up at 5 because they've got a first draft courtesy of AI.
All the banks, their CEOs have been so optimistic about what's ahead.
Here we are flourishing, and so my job is to keep going what James has done so brilliantly.
That was some of the best from Davos, Switzerland and the World Economic Forum. Part of that story, investors paring back rate cut bets for 2024. Morgan Stanley's Seth Carpenter eyed the middle of the year, writing this: "We look for Fed discussions at upcoming meetings resulting in a June start to taper. Earlier than our previous expectation, but the market narrative that the end of QT is coming soon has been overdone. Earlier start will be paired with a slower taper." Seth Carpenter, I'm pleased to say, joins us now for more. Seth, wonderful to catch up with you, sir. Let's get straight into it. The Federal Reserve likes clean sequencing. It's why they waited. Before they started hiking interest rates, they had to wind down QE. Can you just walk us through the QT then rate cut sequencing and the timing of that as well?
Yeah, I mean, I think they do prefer clean sequencing, but when it comes to rate cuts, right now, they've been clear. They want interest rates to be their primary tool for policy, and in that regard, they will take the data as they come and they'll react. So they prefer clean sequencing, but I'm not sure that it's going to be the end of the story. You know, they're looking at different things going on in the economy. Inflation's coming down. It's coming down decisively. The economy is slowing, but in our view, not falling off a cliff. And so they're going to be taking a read on that macro outlook to figure out when to cut rates. Our baseline is June, but the market's sort of, in my view, a little bit over its skis, looking for, you know, now a little bit less probability, less than half for March, but still high probability there. We think the data sort of pushed them off until June. A different part of their conversation is about their balance sheet. So they have said literally for well over a year that at some point they'll slow things down. And the indications they've given us is that the key to slowing down that balance sheet unwind is when the reverse repo facility, that place where money funds are putting their cash with the Fed, once that's been drained down to zero, then they're going to look for a slower pace of things. So they actually are going to have to do a little bit of walking and chewing gum at the same time, but they've been planning this for long enough that I think they can do it.
And this is really going to the heart of some of the quantitative tightening going on. You think that they're going to have to taper it potentially even before they shift and adjust their rate cutting type of schedule. Have you been surprised by how resilient things have been? Are you concerned more now than you were 3 weeks ago about a reacceleration of inflation?
So I'm not really. We've had literally since the first quarter of 2022 a soft landing call. And so Ellen Zentner, my U.S. economist, and her whole team, they've been doing lots of great work. The labor market this cycle is just different than lots of other cycles because we came out of COVID. We came out of a pandemic. Firms are still playing catch up right now. They're finally back to the staffing levels they need. Hiring's coming down, but firing is not picking up. And so in that regard, we feel good that we're not going into recession. On the other hand, if you do any sort of smoothing to the data, things are slowing over a 6-month, 1 year, 18-month time horizon. And so we think we're on this glide path. I don't think we've been swayed too much in one direction or the other by recent data.
All we can say is that after coming back from Switzerland, everyone was just talking about how artificial intelligence will make all of our jobs happier, better, and more productive, and that this is going to be the reason why they are all so optimistic. I'm only talking about the doers, not the thinkers, who are all very pessimistic. But I'm curious, from your vantage point, how much are you modeling this into your sort of soft landing thesis? How much is it driven, in part, by this idea that technology is going to allow a greater efficiency and a greater productivity?
So I'm a buyer of the story that there are productivity gains to be had here. I think the real question, though, is one of timing. So I think so far, my view is the soft landing thesis is somewhat independent of the AI/productivity gains part of the story. I really think it's going to take probably another year, maybe another year and a half before we start to see those really come online. It can't hurt. It will obviously be disinflationary, will obviously be supportive of growth. I think over the long run, it's actually going to be supportive of real wage gains for labor as well. The challenge, though, is going to be how that transition is managed, because there will be, in the short run, clearly some winners and some losers.
Seth, can you help us draw a distinction between correlation and causation? I get that rates have come up, and I understand that inflation has slowed down, but how connected are the two?
I think there is some connection, but it's nowhere near as much as maybe there would have been in previous cycles. So I think it's important to remember that this cycle, inflation took off, not because of the standard macroeconomic impulses. There was clearly some of that. The economy is running hot, has been running hot, the labor market's been tight. But goods inflation just took off because supply chains were disrupted, because consumer spending patterns shifted away from services towards goods, and that drove up goods inflation. That part of inflation has been going away on its own. Similarly, housing inflation shot up because of COVID. People wanted to live differently than they had been before, and we saw an level shift in demand for housing, and that inflation went up. It's starting to come down on its own. So there's a lot of the inflationary pressures that we saw that are going away independently of the monetary policy side of things. But to make sure it gets to 2%, and from the Fed's perspective, to make sure inflation stays at 2%, they have to tighten things to slow the economy down to a sustainable growth rate. And I think what we're seeing now is a little bit of the inflation coming down is from monetary policy. Prospectively, though, that's where monetary policy is really important.
That's what I'm trying to get into, Seth, just how much of the slowdown that we've seen is actually due to the Federal Reserve, because when I look at claims at 187,000, at unemployment south of 4%, shouldn't we be asking the question whether the Fed truly is sufficiently restrictive?
Well, I mean, I think that's a valid question. We should always be asking ourselves that. But look at the housing market. Clearly, housing activity has come off dramatically. New home sales are doing fine simply because there's no supply of existing home sales because people don't want to give up their low mortgages. So we're seeing slowing there. We're seeing some pressure in terms of hiring. Look at how much non-farm payrolls have come down from 6 months ago, from a year ago, from 18 months ago. So I do think we are seeing some slowing in the economy. The economy has been insulated. That same housing market story goes in the opposite direction in the sense that people do have low mortgages. Businesses had termed out a lot of their debt. So that fact is I think, undeniable. But for us, it's also part and parcel to the soft landing story. The Fed's not causing the economy to crash.
I am curious, Seth, just quickly, how much you're watching what's going on in the Middle East, but also the Red Sea, to understand whether that could cause inflationary pressures, if there are longer wait times, if that does create supply chain issues once again.
Crucial question, and I think it's in the news for a very important reason. I mean, a lot of global trade goes through that region. So far, we have seen shipping rates go up. So I think unquestionably the direction of the effects on inflation is there. It's clearly going to be a negative for global supply chains. But, and I think this is really important, we've seen a lot of trade diversion as well. And so even though we are seeing some higher cost of shipping, once we put it through our measure of a global supply chain index, it shows a tick up, but nothing like a reversal of the huge gains that we've made so far. So we think for now, as long as things don't get dramatically worse, as long as we don't get an entire regional conflict, it's going to have only modest effects on inflation for consumer goods.
And finally, just because I'm looking for some kind of holes in this sort of Goldilocks theory that everyone's talking about, I am wondering just internationally how much, as John was mentioning before, the U.S. can remain the lone engine when you have China that seems to be, if not falling off a cliff, certainly sagging in terms of economic growth. Is the U.S. that immune to the slowdown that we're seeing in Europe and also, in particular, in China?
So not immune. We are looking for a slowdown. We're not saying that the U.S. economy is going to be ripping, but we are pretty optimistic. When it comes to China, no question, China's at risk. And we've been saying for a long time, China's at risk for a multi-year slowdown from a debt deflation spiral. But for the U.S., our exports to China are heavily weighted towards agriculture. There's a lot there for the consumer to sort of buy. I'm much less worried about China as a downside risk for the U.S. Economic outcome than I am about, say, some blow up in financial markets.
Hey, Seth. Great insight, as always. Seth Carpenter there of Morgan Stanley. Seth, appreciate the update. Just want to pick up on your point, Elisa, on what you had to say about shipping and the prospect of maybe goods inflation picking up again. Torsten Slok, Apollo, over the weekend writing this. Normally 200 ships travel through the Suez Canal from south to north over a week. That number has recently declined to 100. It's not just the Suez Canal, where traffic has been an issue. Panama Canal as well, because of water levels. Northbound traffic has declined 50% from 90 ships per week to 45. Asking a question about upward pressure on goods inflation in months to come.
And frankly, this is sort of the unspoken truth. It has a much greater effect on Europe than it does the U.S. So is the U.S. going to really have the emphasis on ending some of the Houthi involvement, because the U.S. isn't going to suffer as much as certain goods to Europe? We've already seen certain suppliers, certain manufacturers, Tesla in particular, shift some of the manufacturing away from Europe because of some of these issues.
You saw what the president said over the weekend. Is it working? No. Will we carry on? Yes. Now, this raises a question. Is this about ability or willingness to contain this issue in the Red Sea?
I think it's about willingness. They don't want an all-out war with an Iranian-backed proxy group. This is why they're struggling in the region. This is also why they would like to see an end to this war, and they're putting a ton of pressure on Benjamin Netanyahu, who is saying he doesn't agree with what the U.S. wants, which is a pathway to a two-state solution.
That's the latest on trade. Let's get you an update on some of the stories elsewhere this morning and say good morning to Danny Berger. Morning, Danny.
Good morning, John. Macy's is walking away from a $5.8 billion takeover bid. Investors Ark House and Brigade Capital had offered a deal that represented about a 19% premium to Macy's closing on Friday. However, Macy's board had declined to provide due diligence to investors. Ark House says it is, quote, highly motivated to make a deal. Billionaires Chris Hohn and Ken Griffin are leading hedge funds to one of their best years. Hohn's TCI and Griffin's Citadel together raked in $21 billion last year. The industry as a whole produced $218 billion after fees. That's according to LCH Investments. Their report also shows that the large multi-strat funds are dominating, the likes of Citadel, Millennium, and D.E. Shaw. Meanwhile, the SEC is investigating B. Riley's financials deals with a client linked to securities fraud and the use of his assets to help the bank obtain a loan from Nomura. Bloomberg learned that the agency has conducted interviews about the firm and its relationship with Brian Kahn. Kahn is also involved in a DOJ criminal case related to a multi-billion-dollar hedge fund fraud. Shares of B. Riley are down in the pre-market trade. And that's your Bloomberg Brief. John.
Danny, thanks for that. Coming up on this program, equity markets facing some questionable earnings.
Earnings has been a sort of a puzzlement thus far. Obviously, you've had mixed results. It looks like this is shaping up to be not so great a quarter.
The attention turning from the big banks on Wall Street towards big tech on the West Coast. That conversation coming up next.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
From ours studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action at a new time, 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Live from New York City, equity markets shaping up as follows on the S&P 500, positive by 1/3 going into the opening bell in about 42 minutes' time. Under surveillance this morning, markets facing some questionable earnings.
Earnings has been a sort of a puzzlement thus far. Obviously, you've had mixed results. It looks like this is shaping up to be not so great a quarter. But what's really important is, again, as much of the last year, how the stocks react towards the earnings numbers. And it's not at all clear, given the run we had, that there is much more upside, even if you get the beats that are expected.
That was Julian Emmanuel of Evercore, leaving behind some of the big bank earnings. Lisa, looking ahead to the financials, or rather big tech, in the weeks to come.
Well, they basically are financials, given how much cash they're throwing off, and they're probably investing it in money markets and getting a sweet 5% return. What I'm focusing on is just how much earnings growth they're expecting in some of these behemoth Magnificent Seven tech earnings, of course, kicking off with Netflix and Tesla and Intel this week. The so-called Magnificent Seven are expected to deliver combined profit growth of about 46%. This, according to Bloomberg Intelligence. That's down slightly from the third quarter's 53%. But nonetheless, it highlights why people are hiding out in some of these names. And you can see a huge divergence. AI, NVIDIA, up 20% year to date. And you can see Tesla down 14.6%, Netflix kind of meandering down 0.8%. This divergence really stemming from who's throwing off cash and how much that's really going to determine performance.
This is where the earnings growth has been.
Exactly.
We've drawn comparisons to this period and the dot-com boom, then bust in the late 90s, early 2000. There's real earnings here. And I think that was the difference with NVIDIA last year. When they came out in that quarter, raised the outlook, and you saw that the monetization of this theme was real and present, and it was happening right now.
That, I think, is the key, right? People can sort of poo-poo some of the rally that we've seen, but the bottom line is that's where the earnings has been, and they are monetizing it. With NVIDIA, though, how much is an outperformance baked in? Because remember, if they don't give some sort of crazy outperformance, then crazy increased forecast, people will be disappointed.
Yeah, it's got to be beat and raise and then beat and raise. Gina joins us now. Gina Martin-Adams, the Chief Equity Strategist of Bloomberg Intelligence. Gina, good morning.
Good morning.
Any reason to believe the leadership changes anytime soon?
It should change as the year progresses, but not anytime soon, right? So anytime soon being within the next quarter, very unlikely, because the rest of the S&P 500 outside of this Magnificent Seven is still struggling to post any kind of earnings growth as of the fourth quarter. We could see some transition into better language emerge from these companies, some confirmation that the trend will shift with the first quarter earnings season. I think it's more likely it's not going to come till the second quarter earnings season. Comps get a lot easier for this group as the year progresses, though, so it seems almost inevitable that we will start to see growth out of the 493 in 2024, and that rotation trade has really yet to exhibit itself.
I feel like we should coin this. It's like Magnificent Seven and the less magnificent 493. Yeah. I am curious how much the tech earnings really are going to set the tone in a pretty massive way, and how high the bar is for some of these companies.
Well, so first, let's take a look at what's actually happened during earnings season, because as much as financials may have created some confusion because they did have really big one-time charges to support the FDIC facility when the banks failed a year ago. When you exclude those one-time charges and you look at operating earnings, which is what analysts do, financials are beating hugely in the fourth quarter. Financials are actually on pace to post 2% earnings growth The consensus was anticipating a 2% decline. So they actually set a pretty positive tone, but we got those unfortunate reminders of SVB's failure, Signature Bank failure. We got unfortunate reminders that financials are facing these charges, and that created a little bit of confusion. But to have 85% of companies beating expectations, it does tell you that even for financials, expectations were relatively low. Now for tech, expectations have improved a little bit over the last week, but that's only because TSMC came on a beat. Tech expectations were actually also coming down along with the rest of the market through the fourth quarter. TSMC came out and beat in the middle of the week last week, and that created some uplift, but very little uplift in expectations even for semis. So the bar, believe it or not, is also quite low for semiconductors. If TSMC can beat revenue growth and guide higher, almost every case since 2015 in which they've done that has resulted in a massive beat for the 10 largest U.S. semiconductors as well.
John asked you about a broadening out in leadership. What are you looking at in all of the earnings to understand whether we can start seeing that sooner, or just what will trigger that shift in some of the positioning?
Yeah, I think really importantly, you want to watch what's happening in the U.S. industrial sector. This is the area where I think investors tend to overlook it. We all know that tech is starting to grow and broaden there, right? This is not just the Mag 7, but this is going to be a bigger, broader tech recovery. It does appear that that's likely. We know that financials is likely past its earnings trough. So those sectors seem to be in really relatively solid position. Most analysts are not anticipating anything out of the consumer space anyway, so that's sort of a red herring. You don't necessarily need to watch consumer. What you really need to watch are U.S. industrials, because this has been an area of distress in the economic data, but not an area of persistent distress in the earnings data. So if U.S. industrials can continue to show much stronger earnings growth than the economic data would imply, that's an area of divergence that could create a great deal of optimism. If we can get transports recovering again, if you can get, I think that would be a very, very strong surprise to consensus expectations.
Gina, let's just finish there. I'll throw in another piece of this as well. The relationship between stocks, the data, and the bond market. Last week, yields up, data good.
Yeah.
Last week, equities up, data good. Is there any tension there? Can that stick?
I think it can, because frankly, equities and bonds are both anticipating one thing, and that is slower growth and slower inflation this year. So the upside surprise to growth could very much fuel equity prices, because broadly, the equity and bond market very consistently are saying we're going to have slower growth and slower inflation. If you get the upside surprise coming from growth, the equity market should rise pretty materially. The upside side surprise from potential inflation is the bigger risk, and that could create big disruptions in the bond market and the equity market. That seems unlikely in the very short run. We could start to get upside surprises to inflation over the year, but it seems quite unlikely right now.
That would be a major game changer. Didn't see that last week, but that would be a major game changer.
It would. I am curious with the bond stock correlation, whether we are going back to the 60-40 or whether this is just sort of a breach point before we have a more significant move. I mean, the moves have been sort of tepid relative to the 20 basis point swings.
It's 1 week of price action, but at least last week, yields up, data good, and stocks performed. Gina, it's good to see you.
You too.
Thank you. Gina, Martin Adams of Bloomberg Intelligence. Coming up at 3 p.m. Eastern Time. Don't miss this conversation. Bill Gross, the PIMCO co-founder, to weigh in, Bramo, on this bond market performance.
Yeah, does he still lead in or lean out of bonds? At a certain point, the buy the dip theory is all predicated on this idea that over a longer term, the Fed's going to cut rates, that the U.S. economy is going to slow. It raises a question for stocks too, though.
Counting you down, not just to that conversation, but to the opening bell as well. That opening bell is just around the corner. Your equity market on the S&P 500 is positive. Live from New York City this morning. Good morning. This was Bloomberg Surveillance.
Later got asked to be the head of USAID.
I got that job when I was 36 years old.
36 years old. You're running USAID. How many employees does it have?
We had 11,000.
And did you feel qualified to run something that big?
I did until, the work started.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
The younger generations are more, of course, pay more attention to sustainability. And so they are looking at brands that are greener, but you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From New York City, for our viewers worldwide, I'm Manus Crenny in for Jonathan Farrow. It's taken us 2 years to put in new records and $10 trillion in value. Is it too rich for your blood? We'll discuss on the Countdown to the Open. It starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up this Monday, futures point to more record highs on the street. Investors brace for key inflation data ahead of the Fed. And the Republican primary narrows down to 2 candidates. We begin with a big issue, stress testing, that soft landing narrative.
Here we are in a rally.
The soft landing narrative.
This soft landing environment.
A lot of it is priced into markets at these levels.
And it seems like the whole soft landing is happening.
That seems more likely the case.
At this point, the U.S. economy is faring quite well.
This week, GDP numbers, PC numbers are going to be very important for the Fed outlook.
Growth is going to likely to surprise us on the upside.
We do expect growth to remain positive as we look further out into the new year, but at a slightly reduced pace.
Frankly, the concept of the slowdown, the non-soft landing, is still on the shelf for now.
We're also in the midst of the earnings season.
It's all about earnings at the moment.
It's early days, but we have seen strength coming in from the earnings front.
Tech earnings are supposed to be up in double digits.
The equity market is looking at the strength of earnings.
At the end of the day, if the economy delivers, earnings deliver, markets can move a bit higher.
Non-soft landing is on the shelf for now. Let's discuss the situation. PGIM's Greg Peters, Bob Elliott of Unlimited. Gentlemen, welcome to the show. A very good morning to you. So you just look at the velocity in these markets. Yes, yields have backed up. The S&P 500 and the NASDAQ taking out new records. It's as if the consensus is just for a full bull market. Bob, let me take it to you first of all. Are you a full bull believer or any quaking at all?
I think it just comes down to what momentum exists in this economy right now. And what we've seen through the end of 2023 was one of the biggest financial market easings that we've seen in 40 years. And so given that circumstance into an economy that's already doing, was doing fine through the second half of last year, you're basically getting, if anything, a bit of acceleration in the economy. And I think beyond just the financial market easing and the benefit from falling bond yields, what we're now starting to see is equity market investors are recognizing that earnings may be actually a bit better than they were expecting, at least initially here in 24.
Well, Greg, let's take it to you. I like what Evercore had to say this morning. The dominant risk scenario is that inflation falls faster than expected, and the Fed eases more aggressively, perhaps, than is priced in at the moment. Is that a thesis you can ascribe to?
No, I think that's overplayed, honestly. I think the markets have leaned too much on that narrative. If you look at kind of the distribution, I think investors are really leaning on this. The Fed and central banks will aggressively cut here. Inflation come down even more. I think the risk is the opposite. I'm pretty optimistic, actually. I feel like the economy, particularly in the U.S., is quite robust. Labor market's still strong. Inflation is coming down. But I think this last mile question is very much in play. And, I'm in the camp where the last mile, so to speak, is going to be more difficult, not easier.
Yeah, well, certainly those University of Michigan numbers on Friday help the narrative on the disinflation side of the street. Let's talk about the data this week. Traders are bracing for key GDP prints on Thursday. Mike McKee joins me now. So this is, in theory, going to be a nice bullish trajectory. Mike, good morning.
Good morning, Manus. Well, it is a backloaded week, certainly. The first 3 days of the week, Monday through Wednesday, that's today through Wednesday, not a whole lot going on in terms of data. We get leading index today, Richmond Fed and the S&P PMIs, which really won't move markets probably, but you're right. Then we get to Thursday, and Thursday is a very big day with fourth quarter GDP, jobless claims, new home sales, trade, durable goods orders. We're going to be talking about a lot there. And then on Friday, the biggest number of the week, the PCE inflation number, along with personal income and spending, people want to know, is inflation coming down? Bob mentioned earlier that things depend on how the economy develops from here. And right now, it looks like in the fourth quarter, it was slower than in the third, but the forecast is for basically growth at a trend rate, at a potential rate of about 2%. And that would set us up for a decent first quarter. We'll see what the numbers turn out to be here. And then here's the numbers that we're looking for on Thursday and Friday. I mentioned the GDP number, but incomes are expected to have fallen a little bit, the rate of gain, and spending hanging in there. We saw that with the retail sales numbers. But the real number that we want to see is down in the lower right-hand corner there. That's core PCE. The forecast we have right now from economists that we survey is it'll come in on a year-over-year basis at 3%. But a lot of people who study this very closely say there's a good chance we get 2.9%. If we get a two-handle on that, that could really change some market psychology about what the Fed is going to do. Finally, I just wanted to throw this in here because this is going to be the key to the PCE numbers. The difference between the PCE and CPI housing constructs. CPI, this is a normalized version going back to 2016. CPI, it's a much bigger weight, and the way they calculate it, it shows housing prices much stronger than the PCE does. So if you're looking for the possibility of a two-handle on PCE inflation, it may well come from housing this time.
Mike, thank you very much. Yeah, let's see whether the housing market lights up again later this year. Bob Elliott, Greg Peters are with me. Let's just take what Mike put on the table there for us. It's all about that print on the PCE, which is critically important to the bond market and to the risk narrative. A sub 3% print on PCE. What would that do, Greg Peters, to the pricing in the bond market? Obsessed by 6-7 cuts, with the Fed at 3, would it close that gap? Would it change the narrative if we get a sub 3% print in the PCE, Greg?
Yeah, so I think it's a big psychological barrier. So below 3, it's closer to 2, of course, but you're still not at 2. So there's still lots of room to go in terms of the disinflation is concerned. But the The labor market and what that means for wages and how that flows through services is critically important. And then, as Mike was talking about, housing. So all eyes are on housing. So it's about the components of core inflation now, and that is really a close lens on labor and housing.
Bob, let me take it to you. I mean, that sub 3%, what would that do for you and your perspective on the rest of the year? Because they'll all start to cry about 50 basis point cuts. Once we get a reasonable level below 3%, you can just hear them, you know, sort of almost like in the football stands, crying for 50 basis point cuts at a time. But how would you look at a sub 3% print?
Well, I think mostly that sub 3% print is priced into market expectations, and particularly when you look at what's priced into the short rate market in 2024, that 6 to 7 cuts that are already priced in are reflective of an expectation of a significant moderation in inflation. The real question from the Fed's perspective is whether or not just getting inflation back down to close to their mandate is enough to start to create a substantial cutting cycle, particularly when we have a situation where growth is pretty good and asset prices are making new highs. Plus, there's the concern about break-even inflation and long-dated break-even inflations starting to rise back up here as asset prices improve. And so I think part of the insight that you can get is from the SEP, which isn't just saying that they're going to cut 3 times, but it's reflective or it is consistent also with a period of time where unemployment rises to 4.1%. So the idea that the Fed's going to immediately start cutting if unemployment stays here in the 3s, growth is pretty good, and PCE just moves to mandate, it's not obvious that they're going to get the sort of cuts that are currently priced into the short rate market for 24.
Well, let's try and just square it away with a little bit of reflection on assets. Greg, if I bring it back to you, I've got Morgan Stanley, I've got JP Morgan saying on this backup in yields, you want to stagger into this, you want to layer into this on the bond side. I mean, the table is set to, I suppose, justify that kind of narrative. For you, is this rich enough for you to step back into duration at these levels?
I think that's too cute of a narrative. You know, we see a very wide range actually for the 10-year this year. You know, almost 100 basis points. So, I mean, maybe there's a little value from a trading perspective, but not a ton. We don't see the same kind of rate cuts coming through. The markets have been so aggressive in terms of that pricing. We think that pricing will come out of the market. We're so data-driven. We have geopolitical risk. So I think to be so declarative in such a volatile, uncertain market doesn't make a lot of sense. So
can I ask you where you see the equilibrium rate then? Perhaps the more pressing question is, where do you see the equilibrium rate? That's what Stephen Major and the HSBC team are talking about. That's more important than whether it's 2 cuts, 3 cuts. Where do you set your equilibrium weight in the medium term?
Yeah, so I mean, if you use the SEP, I think the SEP is, you know, the long-term real interest rate. You know, we do see you know, above 0, which is not where it was. So we think there's some scope for rates to move lower, but not a tremendous amount. So if you just kind of take the nominal 10-year as an example, you know, our kind of fulcrum is around 4%. So plus or minus around that.
Bob, let me just square it away with you. 35% from the October lows. We're trading a value up of $10 trillion on equities. Is this market too rich for you to step into, or do you think it's still got valuation to go?
I think it really comes down to a momentum trade here. And the basic idea is that as the economy continues to press higher and reaccelerate here in the early part of 2024, we're really seeing what you'd expect to play out from a macro perspective, which is stocks that consistently outperform bonds. And I think we're set up in a circumstance for that to persist for at least the first half here of the year.
Okay. Well, we're all in for the first half. I don't think anybody has any perspective of what the medium term is. Bob Elliott, Greg Peters, thank you very much. You're going to stick with us. We've got a little bit more work to do. Look under the hood. Abby is back in the seat ahead of the opening bell. Abigail, what have we got?
Well, despite the fact that we have futures higher, we have a couple of notable names down sharply. In fact, if we start off with the shares of Gilead, the bioscience giant, well, this stock at the lows down more than 10% right now, down 10.5%. This, of course, is a late-stage lung cancer treatment, failed to improve survival. Investors not liking the outcome of that binary event. Archer Daniels Midland, the ag giant, down 17% or thereabouts. This after they placed their CFO on leave. They've cut their earnings guide, and something that no investor wants to hear, an investigation into their accounting practices really weighing on those shares. And then a bright spot, Macy's up 1.5%. The department store rejected a $5.8 billion offer from an investor conglomerate. That's roughly $21 per share, 19% above the Friday close. They're saying they don't think it offers compelling value. The fact that they rejected it maybe has some investors hoping that they think that there's a better alternative.
Okay, well, we'll keep an eye on those stocks. Abigail, thank you very much. Coming up on the show, the GOP race is down to 2.
I am today suspending my campaign. I'm proud to have delivered on 100% of my promises, and I will not stop now.
The latest on the 2024 campaign trail next on Bloomberg.
All this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the servers, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going, through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have, Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time we'll be fully transparent on viewing data.
This is Bloomberg.
Today suspending my campaign. I'm proud to have delivered on 100% of my promises, and I will not stop now. It's clear to me that a majority of Republican primary voters want to give Donald Trump another chance. I signed a pledge to support the Republican nominee, and I will honor that pledge. He has my endorsement because we can't go back to the old Republican guard of yesteryear.
Cutting and running, Florida Governor Ron DeSantis announcing his exit from the 2024 presidential race narrows the GOP field. The focus now turns to New Hampshire, where the former President Donald Trump and former UN Ambassador Nikki Haley will square off in the state's primary election tomorrow. And we got the latest CNN polls. This is what we got. Trump leading Haley with 50% support among the likely Republican primary voters. Bloomberg's Katie Lyons has the latest now. Katie, good to see you on the road in Manchester, in New Hampshire. So it wasn't so much people were saying a shock that DeSantis has gone. It's just the timing of it. So here we are, the field is narrowing. The question that Terry Haynes raises is, where do the lost voters go that have disappeared from DeSantis and from Chris Christie? Good morning.
Good morning, Manus. Yes, that exactly is the question. Of course, Ron DeSantis, when announcing his departure from this race yesterday, said that if he could have campaigned more, if he could have done more interviews, he would have. But ultimately, he saw no path to victory. And that is why he has exited this race really on the eve of this New Hampshire First in the Nation primary. The thing is, he wasn't much of a factor here in New Hampshire to begin with. Yes, he came in second place in Iowa, but here in New Hampshire in polling, he was in the low single digits, something around 6%. So it's not like there are really that many DeSantis votes that will be shifting to either Nikki Haley or Donald Trump here. It does seem the prevailing thinking among Republican strategists I've talked to is that the majority of those votes will be going to Donald Trump. But Trump was already leading Haley here even before DeSantis dropped out. That lead, though, has just expanded as we've gotten closer to actually this primary vote happening. In the latest Suffolk University Boston Globe poll this morning, Trump is 19 points ahead of Haley. Now, as we've gotten closer to the vote tomorrow, Nikki Haley does seem like she is starting to lower expectations for herself, as are her surrogates. Haley said she just wants to perform stronger than she did in Iowa, where, of course, she came in third. And her biggest surrogate here in New Hampshire, the governor, Chris Sununu, who I spoke with yesterday, said she doesn't need to win. A strong second is what they're looking for. That said, New Hampshire is the electorate that really Haley's candidacy is trying to cater to. There is a lot more Republican moderates here, a lot more independents, unlike Iowa, which leans very conservative. So if she can't pull it off here, it is difficult to see the path for her campaign moving forward. Of course, the South Carolina primary, her home state, is about a month from now on February 24th. But if she can't win in New Hampshire, there is a question of whether or not she can sustain momentum to get her to that point in the race, especially when former candidate after former candidate and others are all falling in line behind Donald Trump as he remains the far and away front runner, Manus.
Yeah, and the velocity behind him getting that nomination is a lot quicker and a lot earlier than we saw in 2016. Kayleigh, we wish you well. Enjoy yourself there in New Hampshire on the road, the whole Bloomberg political team, Kayleigh Lyons. My guests this morning are Bob Elliott and Greg Peters. Gentlemen, you've been through a cycle or two, perhaps more than me. It's my first American election. You're veterans. So with that in mind, we are seeing this field narrow quite aggressively, quite early. What did you learn from 2016 that you now reflect and you go, this is how I'm looking at this at the moment? Bob, take it away.
I think the most important thing, lessons from both 2016 and 2020, is that what ultimately happens on election day is less certain than I think many would hope for. And so in that sense, I think, most folks from a market's perspective should be looking at this and ensuring that they're not overweight one particular candidate's success versus another as they navigate through this, what will inevitably be a very volatile political story over the course of the year. I think the thing that's probably interesting here relative to where we were a couple of cycles ago is that the parties are more aligned when it comes to their fiscal policy in aggregate than maybe they have been in the past. Seeing fiscal expansion pressures from both sides of the aisle here through the course of the last, say, 4 years. And it's really going to be a question of what does that composition look like? Is the fiscal expansionary policy going to look more tilted towards lower income cohorts getting transfer payments, or is it going to look more like tax benefits for corporations and higher income individuals? That's really the mix. It's less about the overall spending profile and more about the mix from a policy perspective.
It's about, where does the benefit come down? And I suppose, Greg, I was reflecting back to 2016. We've got a lovely article on the Bloomberg Terminal this morning which talks about, what happened then, and perhaps we'll have a less volatile reaction now. 10 billion went out of bond markets, the biggest since the taper tantrum of 2013. But when you look back at 2016 and 2020, is it too early? Is it too early to have a little bit of a hedge in there?
I think it is too early, and I think the response will be different as well. If you go back to the 2016, I think what took the bond market by surprise was the deficit expansion. So I don't think that'll be a surprise this time. I think both parties are aligned, so to speak. The contours will be different, but I think deficits are here to stay. But I actually think if there is a change in leadership, it'll be a much more violent reaction this time around than what we've seen before, as I think, Europe in particular is preparing for such a change. And if you look at a lot of the policies, a lot of those policies could get rolled back, and I think that'll be quite meaningful. And if you look at just one aspect, the change in the labor market could be quite important, as we've seen a real expansion in labor here in the U.S., foreign labor in particular, and a much tighter immigration policy could really roll that back and have a real effect on inflation. So I think it's different.
Briefly, before I go back to Bob, can I just, deficits are here to stay, but will they be tolerated ad nauseum by the bond market? The Brits find out that doesn't always happen. Briefly?
I think so. It's always tricky. It doesn't matter till it matters. So I don't think that is a predominant concern, but I think it will be a lingering concern.
Okay. Bob, let me just take it back to you in terms of thinking about markets as we close out in this New Hampshire. We've got a lot to be bullish about, but what are you most concerned about?
Well, I think the main question is whether we get a reacceleration in inflationary pressures. We're really in this sort of perfect moment where PCE is printing right at where the Fed wants it to print over the last couple of months. And the question is that able to persist? And, I think there's a lot of reasons why one should be cautious, including the Fed. First of all, just break-even inflation pricing out on the curve is starting to rise, which reflects, is market-based reflections of rising concerns about longer-term inflationary dynamics, but also the big reasons for the big drivers of this decline in PCE inflation, things like falling gas prices, falling auto prices, the decline in durable goods prices. Those all have to persist. Those declines in prices have to continue in order to continue to get PCE inflation at this level. If they don't, they just moderate, we could easily see PCE pop up in the later half of the year.
Gentlemen, thank you very much. Bob Elliott, Greg Peters there with the very latest on the markets coming up. The morning calls and State Street's Laurie Heinel joins me with her views for 2024 on Bloomberg.
Much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Some morning calls to set you up this Monday. Oppenheimer downgrading Lowe's to market performance, citing a challenging environment for home improvement. Morgan Stanley names Western Digital as its top pick among the U.S. semiconductor stocks, highlighting compelling valuation compared to the peers. And finally, HSBC cuts Lululemon, price tag $500.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action at a new time, 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
It took us 2 years to make these new record highs across U.S. equities. We've added $10 trillion in value. We're getting ready to fly to somewhere very special up there at the NYSE. This is State of Play. Equities on higher. We're careering through new record highs in terms of valuations. You need to ask yourself, a forward PE of 20, is that rich for your blood? We are in an earnings season where financials are outperforming. It's a huge week for Netflix and technology. Euro-dollar flat. Yields in 10-year government bonds, waiting for the PCE, sub 3%. What would that do to bonds? Would it create a rally? Sub 4%, and oil is up 1% at 74.11 this morning. One stock to watch at the open, it's Macy's. The retailer saying it's not interested in a $5.8 billion takeover from the investors. Abigail Doolittle will justify the narrative for Macy's. Good morning, Abby.
Good morning, Manus. And it seems that Macy's knows its value when it comes to potential suitors. Very, very picky, as you said, rejecting that $5.8 billion bid from a group of investors. $21 per share, 19% above Friday's close. Given the fact that this stock is still down 75% from its all-time high. It suggests that if they're not taking that bid, and they did review it, but the board said that they were not going to sign an NDA and they were not going to do due diligence, it suggests that they think that maybe there's a better offer to come, or that they will learn how to go it on their own and be more successful in doing so. So while they are not pursuing this possible deal, Manus, and we do have the stock off the highs. At the highs, the stock had been up solidly, again, supporting this idea that investors think that maybe something better is to come. CEO Jeff Gannett did say that the company will be open to opportunities that are in the best interest of the company and shareholders. Stay tuned.
Okay, Abby, thank you very much. Let's turn our attention back to Boeing and the airlines. The FAA is asking the airline to check the door plugs on a second 737 model after more issues were found. Katie Greifeld is with me. So this is an older form of the 737. Size and scope. Katie, good morning.
Good morning, Manus. Yeah, Boeing down a hair this morning as that scrutiny spreads. The FAA now recommending that airlines expect Boeing's 737-900ER models as well. Now, remember, the model that was involved in that Alaska Air incident earlier this month was a MAX 9. But the 900ER uses the same type of plug that failed on that MAX 9. Now, the FAA said in a statement that this move will offer, quote, an added level of safety, given that some 900ER operators have noted findings with bolts of this model during their inspection. That also according to the regulator. Now, obviously, manufacturing quality is undergoing intense scrutiny at the moment. The FAA launching a probe into Boeing quality. That's in addition to increasing its oversight of production and manufacturing. Boeing, for its part, says that it fully supports the FAA in this action. Now, of course, this entire episode, if you want to call it that, it's really left a mark on Boeing shares. They're down 18% already in 2024. That is the worst performance in the Dow, Manus.
Okay, well, we've got a spectacular drop on Archer Daniels this morning. Katie, thank you very much. Let's move the agenda along. Talking agriculture, ADM placing their CFO on leave, cutting their forecast, and they have an investigation that is ramping up. Isabel Lee joins me now with the details. Isabel.
Hi, Manus. The investigation is sending the stock spinning lower by 18%. That's the biggest drop since 2005. And as you can see, shares are still down by almost 17%. Lots of moving parts here, but shares really tumbled when the company said on Sunday afternoon that Vikram Luthar, its CEO since 2002, was put on leave. And we have Ismail Roig, who will serve as the interim CFO. And ADM is also delaying its fourth quarter earnings and the filing of its annual report and Form 10-K for 2023. So lots of moving parts here. And so far, things aren't looking good for the company, Manus.
Okay, Isabel, thank you very much for the details on that. Let's turn our attention back to the airlines. This is a battle royal. JetBlue and Spirit appealing the ruling that's blocking its planned $3.8 billion merger. Natalia Kanijevic joins me now with the details. Hope lives eternal, Natalia.
So yes, the move comes after a U.S. judge blocked this deal, saying that this will lead to higher prices and fewer choices for U.S. customers. Now, JetBlue needs 200 aircraft and about 300 pilots from Spirit. At the same time, Spirit needs financial support. Some analysts are saying that without this deal, Spirit may file for a bankruptcy or a liquidation. Spirit is trying to manage its finances, is trying to pay down its debt, refinance some of its debt. A large part of $1.1 billion is coming in September 2025. But this comes at a time when costs are rising. They have a new contract with pilots, and they have to pay 34% more in the next 2 years. Overall, stock plunged 67% last week, and now basically many sell-side analysts are getting more bearish. We see a huge spike in shorts. Short sellers are betting against the stock. And the key question, Manus, will JetBlue fight for this deal? Because when they made an offer, they offered the $33.5 a share in cash, and now Spirit shares are trading at around $6 a share.
Okay, Natalia, keeping an eye on those airlines throughout the street this morning. State Street's Laurie Hanna joins me now ahead of this year. She writes this: we anticipate uncertainty to persist, subtrend growth projected across global economies. 2024 will likely be a year of flux, with many factors pressuring the path to the global economy. You wouldn't think that if you look at the S&P 500 and the NASDAQ now. Laurie, good to see you this morning. I mean, we're sort of like full bull, but should I have a little bit of metal jacket around me? Good morning.
Good morning. Yes, we think that 2024 is going to be a lot more precarious than markets are certainly appreciating right at this moment in time. Certainly, we've seen the Fed signal that they're done raising rates, but they haven't started to reduce rates yet. And we still believe that there's more to come in terms of, tight policy working its way through the system on refinancings and things of that nature. So we do think it's a year where we're going to need to see earnings momentum, which early days looks pretty good in the U.S., but it's one where the kind of lofty valuation levels give us some pause.
And that's where I want to dig a little bit deeper. Everybody has their own preferred theory. I've got a couple of stats. The NASDAQ is trading 30 times its profits. Yet I look at Magnificent 7 and we expect profits to drop from low 50% rise to 46%. So on profits times earnings, is it getting rich or has it got capacity to grow further?
Well, we think if you just look at trailing earnings, you'd say it's rich in here. And this is the crux of the matter, is what will earnings be going forward? And will companies be able to navigate still, impressive inflationary pressures in a lot of pockets, albeit declining somewhat? Will they be able to navigate the slowing growth environment? And where are those companies who have some resiliency in their balance sheets and in their revenue streams to be able to work through this? So we do think it's going to be a pretty precarious time, not just because of current valuations, but what that implies about forward valuations based on forward earnings.
And in terms of the S&P, if you look at that, that's trading as well. Some would say sub its peak. We're trading around 20 times on forward earnings on the S&P 500. The peak was a couple of years ago, 23. Again, the question there is, do you think that it broadens out? Is there still an opportunity there to go below the index itself and to broaden the position there?
Well, a couple of things there. I mean, first and foremost, again, as I just mentioned, it's not just about what the current level of price earnings is, but what the forward earnings capacity is and how that's going to evolve and how much confidence you have in those earnings being able to expand through time. And that gets back to the crux of your question. We do think that this market broadens out. We do think that the sort of narrow, Magnificent 7 kind of drive in stock market over the last year or so has to be complemented by some broadening out. And we're starting to see that. Certainly, we're starting to see financials participate. We're starting to see other parts of the market. So we think that we're in a place where equities going forward can do okay, but that's going to be dependent upon earnings coming through and the breadth of the market.
Now, look, we've seen this rates market readjust. I mean, it was almost a quasi-easing that you had in financial conditions in November and in December. We've backed up a little bit. Here we are on the bond market, and I've had various notes come through this morning from Morgan Stanley and from JP Morgan. Now is the time to buy the belly of the curve. Now is the time to reconsider some duration. Does that make sense for you, the belly of the curve at 5 years, to pick that up at the moment?
It does, and we've said in our market outlook for 2024 that we think the best place to deploy capital is actually in rates. And we actually think that that part of the curve looks pretty attractive, both because we do think that growth will continue to slow. We do think that inflationary pressures will come down, and we do believe that the Fed will ease. And all of those three things really do point to relative value in that part of the curve. Mind you, we could also get some incremental appreciation if things slow even more precariously than we envisage. So we think that's a good place from a risk-reward standpoint.
Consensus is just so bullish. I'm always queasy. It was so bullish last year. China will reopen, buy luxury stocks. I can't remember what else it was. Recession will come. Recession didn't come. China did not go at full bull. Luxury found it hard to put through price rises at the end of the year. Do you join me in a glass of moderate skepticism with consensus so bullish?
Well, I do, although I would say that there are pockets that are actually not participated at all. I mean, China being foremost among those. So there are some pockets around the globe where we do think that there's going to be a lot more stress going forward. We think emerging markets is still a place where we would tread cautiously, particularly in the equities. We think Europe, while pretty attractively valued, has a lot of headwinds as well. And oh, by the way, we've got this massive set of geopolitical tensions that are likely to weigh on market sentiment over the coming year. So I do think you have to be very defensive in here. Look at quality stocks. Look at those places where the risk reward is pretty attractive, and try to hold some cash so you can take advantage of opportunities as they present.
And last year, a lot of people held on to a lot of cash, didn't they? And here is the question between the money market funds and institutional hoarding of cash. Do you see that being incrementally released back into the market? Because there's a risk, isn't there, that you wait too long for the rate cuts to come before you deploy, and perhaps you miss the trade. What is your thinking in terms of the time release valve, if we can think of it that way, on the money market funds and on the money in CDs?
Well, at the margin, more flow into equities out of cash would be a good thing for markets. But let's just not forget that that's still a relatively small number versus the market capitalization of equities. So we don't think it's the major thing that will move the market. And oh, by the way, what we've seen is consumers tend to be late to deploy those cash assets into markets. So it may take a couple of rate cuts before they actually realize that money market funds aren't the most attractive place to be. So we don't think that that's going to be the thing that will drive markets higher. It's going to have to be earnings coming through and more confidence in the global economy.
Just to reflect back for one global perspective, I'm looking at the positioning in China. Again, if I go back a year ago, it was about the momentum in China. I look at the Hang Seng Enterprises at a 2-year low in Hong Kong overnight. UBS say you need punchier policy to really get involved in China. The fund managers cut their allocation there. At what level are you allocating to China and to Asia?
Well, first of all, for a couple of years now, we've been recommending to our clients that they separate out China from their broader emerging markets allocation, both because it was such a large proportion of the index and because we thought that the drivers of China recovery and China performance were likely to be disconnected from the broader emerging markets complex. So we think that first thing you would do is you just separate out your China allocation so you can make those tactical bets based on what you see in China. Look, China's got a lot of challenges. It's slowing much more than people had envisaged. They continue to have challenges in terms of population and unemployment and real estate and a variety of other things. And oh, by the way, without the same kind of policy flexibility that they enjoyed over the last decade. So we would very much tread cautiously on China at this point in time.
Laurie, thank you very much for being with me. That is State Street's Laurie Heinel with the risk rewards and a little bit of caution on your China exposure. Coming up, a whirlwind, 2 weeks of central bank decisions to kick off 2024.
Our view in the end is that we think there's a very good chance they do 50 in March. So not even just 25, but a 50 basis point cut and start with a bang.
More on the rate cut trajectories for 2024 in just a moment on Bloomberg.
Later got asked to be the head of USAID.
I got that job when I was 36 years old.
36 years old. You're running USAID. How many employees does it have?
We had 11,000.
And did you feel qualified to run something that big?
I did until, the work started.
do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. You know, we don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Because inflation's fallen so much, the Fed can afford to be very aggressive. And on top of that, because of the US election, the Fed would not want to act too much in the second half of this year. So essentially, they're going to try to force all of their cuts into the first half of this year. And so our view in the end is that we think there's a very good chance they do 50 in March. So not even just 25, but a 50 basis point cut and start with a bang.
That was Bilal Hafez there of Macro High, weighing in on where he sees the future Fed moves. And we're going to get a flurry of central bank decisions over the next 2 weeks. The BOJ kicks things off on Tuesday, where they lay the groundwork for exiting negative rates and yield curve control. The ECB follows on Thursday. The Fed delivers their decision the following Wednesday. And finally, we hear from the Bank of England next Thursday. But first, let's start with the ECB. Christine Lagarde saying last week in Davos that it's likely that the ECB will cut interest rates this summer. Bloomberg's Zoe Schneeweiss joins me now from Berlin. So there she was at Bloomberg House in Davos, laying the groundwork for timing, but with many caveats. The market, how did it embrace the summer prospect of a cut?
The market did actually moderate its rate bets, because the market before that had seen rate bets as at 80% likelihood for an April move already. And the next move after that would be that June move, which is what actually most of the policymakers seem to be hinting at. We've got one or two doves who maybe say earlier, but overall there's some vital wage data coming, and that won't be here till late April, maybe early May. So that's why they'll need to wait to the next meeting after that, and that's the June meeting, to look for cuts. So this week will be hold, but we will be looking very much for any hints that Lagarde may provide on the timing.
So tell me this, the market is pricing in, as you say, we've shaved back a bit of our enthusiasm, but the market overall was hoping for 150, 160 basis points from the ECB. Is the disinflation narrative in Europe as robust as it is in the US?
Maybe not quite. We have the danger here that there are some upticks again. We saw an uptick of inflation in December, and just with so-called base effects mean that there is the danger that now the next few months there could be additional upticks. Nothing drastic, nothing like the 10.6 inflation rate we saw in October 2022, but still that's obviously going in the wrong direction if there are any upticks. And again, there's the scare here that those tensions we see in the Red Sea, or again that wage data will again drive rates and will drive inflation expectations, which is the thing the ECB really is looking at, will drive them up and then mean that they can't start cutting rates in June even.
Okay, well, the Italians must be cheering this morning for a Monday. Italy, German bond spreads, the lowest in almost 2 years. Gone from the heady days of the debt crisis. Zoe, thank you very much. Let's see what comes over the next couple of weeks. Zoe Schneeweiss in Berlin. Turn our attention to the BOJ. Mike McKee is beside me here. So, Mike, what kind of guidance from the BOJ might we get? Because that seems to be the building narrative. It'll be maybe about guidance rather than action.
Yeah, they've given us a lot of hints about what they want to do, but no hint about timing, and that's what people are going to be looking for this week. The Bank of Japan has two things that they've got to deal with. One is, as you mentioned earlier, negative interest rates. They haven't had their main policy rate above zero for many, many years, the blue line there. And then, of course, what are they going to do about yield curve control? They've basically taken it off, but the market is acting like there is still a cap on the 10-year note yield, and so we'll see if they give us any guidance on which one of those. The market certainly thinks that something is coming. JGB volume has woken up. It's now kind of at the highest rate that we have seen since the great financial crisis. All of a sudden, people are getting active again, but they don't think it's going to happen tomorrow. The economists at this point think there's a 0% chance of any policy change, the ones we've surveyed. Only an 8% chance in March. It's April that gets most of the attention. People are looking at this point, about a 60% chance that the Bank of Japan does something in April. And the reason is, in March, they conclude wage negotiations across the country. They do some pattern bargaining with many different companies. And what the Japanese want is something very different from what the ECB and the Fed wants. They want higher wages because it'll keep inflation up. This is the Prime Minister yesterday saying it's essential to raise pay at small and medium-sized companies. So if they get that, then we are likely to see the Bank of Japan do something in April. Until then, it's all going to be about the hinting.
Indeed, and he talks about a wage growth outpacing prices needed for a virtuous circle. Always interesting when you hear politics versus central bankers. Mike, thank you very much, Mike McKee. And dollar yen is probably one of the biggest disappointing trades out there. 147.83 is where we trade. Let's see what the Bank of Japan can do to the yen tomorrow. Let's get under the hood, into the sectors. Abigail Doolittle is with me.
Well, we do, of course, have the S&P 500 at another all-time high today, Manus, and it's a broad sector composition supporting that gain. 3 up days in a row for the S&P 500. Real estate, the best sector. All components of that sector higher. I'm not exactly sure what's behind that, but then right behind it, communication services. To the downside, we have very small declines for consumer staples and energy. So again, this gain that we have today, very well supported from a number of the sectors, the breadth that people want. As for the big participation, though, in recent days, weeks, and frankly, the year, over the last year, big tech, well, there's that NYSE FANG Plus index over the last 5 days, up more than 3.5% into, of course, ahead some of those mega cap tech earnings.
Yep, we're expecting, what, a 46% growth in profits. Let's hope that they deliver. Abigail, thank you very much. Great work on the sectors there. Coming up on the show, the events that you need to watch for your trading diary. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Quick look at equity markets. You've got a little bit of breath coming in there. The Russell up 1.74%. Again, continuing through with record highs on these equity markets. You're going to get a little bit of tech flavor this week from Tesla, from Netflix, to name but a few. Your trading diary, this is what else will focus the mind. The BOJ rate decision and the New Hampshire primary. Plus, as I say, Netflix reports their earnings. Have you shared your password? Wednesday, tech earnings continue, Tesla and IBM. And then Thursday, it's the ECB's turn. We'll also get the US GDP, expecting a strong growth in the US. And American Express reports on Friday. That was countdown to the open. This is Bloomberg.
All this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the service, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time we'll be fully transparent on viewing data.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Yeah, how about that? Alex Steele, Paul Sweeney, we're together. Alex, we're talking Bloomberg Intelligence for another 2 hours.
We have a promo.
I
feel like I have advanced in my career at this point.
Exactly.
Get your own promo.
This is amazing.
Oh, you made it.
Matt Miller's out. He's still on paternity leave, so he's okay. He'll be back at some point. But so Alex and I, for the next 2 hours, we're going to do this thing. We're going to call it Bloomberg Intelligence.
Yep.
Talk a lot of companies, a lot of stocks. Talk about the market, see what's happening here as we get into the middle of the trading day. So we're going to do that for the next couple hours. And that'll take us from 10 to 12 Wall Street time every day. So that'd be cool.
Yeah, and we have a weekly podcast that goes up on the weekend where we dive into Bloomberg Intelligence and all their research of all the companies and industries around the world. And so we thought we'd sort of formulate that into a day-to-day analysis. So it should be really, really fun.
And we're streaming on YouTube, so you can head over to YouTube and check us out, youtube.com, and search Bloomberg Radio. We're also, obviously, from the Bloomberg Interactive Brokers radio studio in New York City. Coming up today, Alice, we're going to talk to Chris Broderson, Managing Director of Eisner Amper Business Advisory Group, to talk about Bitcoin ETFs. I'm not sure what's going on there. I know they were just ripping there a couple weeks ago when they first got approved. We're also going to check into Bloomberg congressional reporter Laura Davison. I believe she's up in New Hampshire, a little chilly up there, but getting ready for the first primary of the year. So we'll go a little politics there. But let's kick things off on this historic day with John Tucker and a Bloomberg Business Flash.
Great to be part of history. And this Bloomberg Business Flash being brought to you by Interactive Brokers. Interactive Brokers clients earn up to 4.83% on their uninvested, instantly available U.S. dollar cash balances. Rate subject to change. Visit ibkr.com/interest rates to learn more. Well, stocks just keep adding to the gains after Friday's record close. You have 9 of the 11 major industry groups in the S&P 500 higher. Real estate in the lead right now. The biggest drag coming from consumer staples, a defensive sector. Individual shares, Western Digital among the biggest individual movers in the index. Named the top U.S. semiconductor stock by Morgan Stanley. The biggest laggard, that's Archer Daniels Midland. Well, after Friday's close, where are markets headed now? We put that question to Lori Calvasina of RBC Capital Markets.
So it looks like the bull is fighting back as hard as it can. That being said, I do think we've still had a bit of a sentiment problem coming into this year. So it would not surprise me at all to see this rally take a bit of a pause. But ultimately, we think there's room to move higher at the end of the year. We've got 5150 on the S&P.
Well, so far, 52 companies at 11% of market cap reporting earnings in the S&P 500 on track for 1.8% year-over-year earnings growth in the fourth quarter. Right now, the S&P 500 up 24 points. That's a rise of 0.5%. 4864 on the index. The Dow Jones Industrial Average up 200 points. That's up 0.5%. The NASDAQ 100, 79 points higher. That's up 0.5%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. So good to see you in the studio. Alex and Paul.
Isn't that a big...
I was talking to Alex, not you.
Isn't that a big improvement over Matt Miller? Let's be honest. I mean, let's speak. I mean, nobody's listening.
Well,
we can be.
Be careful what you wish
Hit
for,
a guy
right? Because
when
he
he's
like
down.
cars, I like oil.
Oh,
So
yeah.
at some point, Paul's going to be like, "Can we get that car guy back,
We're
please?"
talking a lot of energy going forward. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So go to youtube.com and search Bloomberg Radio, and that's where you'll find us here. As John was just reporting, a little bit of a lift here to the market. The S&P up 0.5%. Let's check in with Laura Melinda. She covers all these markets for us here for Bloomberg News. Nora, what are you looking at today?
So as John just alluded to just a bit ago, I'm watching Archer Daniels Midland, that's ticker ADM. It's plunging as much as 18%, wiping out almost $6 billion of market value, and it's the biggest laggard by percentage in the S&P 500. This all comes after the Chicago-based agricultural trading giant suspended its chief financial officer and cut its earnings outlook ahead of a pending investigation into its accounting practices. ADM now expects to deliver more than $6 $2.90 per share in adjusted earnings for the year, after having forecast in October profits in excess of $7. And this isn't the first scandal involving ADM. Back in the 1990s, it was actually implicated in a price-fixing conspiracy that later became the basis of the 2009 film The Informant. We all know, starring Matt Damon.
Really? That's right. Okay.
Now it all connects.
A little bit of history there.
Okay.
But it's really interesting as we're seeing this as the biggest laggard in the S&P 500. Alex, I know that you are always following the commodity space, but this one is just some really big news.
Yeah, you definitely want the CFO to be the guy in charge of accounting and having an accounting problem. I mean, at the end of the day.
No, I'm just looking at the holders of this thing. It's all the big firms own this thing, left, right, and center, so it's going to be...
Well, so there's only 5 of these guys.
Yes.
Of the big grain traders and providers and producers, there's a very small percentage of, there's only 5. So, one of them goes out of bed, and what are you going to do with the rest?
Wow, interesting. What else you got, Norm?
Western Digital, that's ticker WDC, up as much as 7.2%, climbing for its highest level since June of 2022. It's one of the biggest gainers in the S&P 500 by percentage after Morgan Stanley named it its top pick among U.S. semiconductor stocks. The analysts have raised their price targets to $73 from $52 on the data storage device makers, citing compelling discrepancy between its valuation and that of its peers.
All right, so Western Digital, don't you just buy all the semis or sell all the semis?
Don't you do SOX? SOX?
SOX. I mean, it just feels like if you're buying one, you're buying all of them, aren't you? I don't know.
And especially with Morgan Stanley, right? They're a little skeptical on more the lower quality cyclicals, but clearly they like these guys. It's like a way of playing big tech without playing big tech.
Yep.
At the end of the day, kind of, sort of.
Very good.
And taking a look at the SOX index is actually surging for its highest levels on record. Okay. So we are seeing it propelled.
Tech is moving higher.
Tech is moving
therefore,
higher.
all the rest. All right, what else you got?
Looking at B. Riley Financial, that's ticker RILY. It's in focus today. It's a pretty small stock, but very well watched. The SEC is investigating B. Riley's deals with a key client, Brian Kahn, who was linked to a securities fraud. The firm is being accused of using the client's assets to help obtain a loan from Numera Holdings.
That is not bueno.
Uh-oh.
No. I'm looking at the shareholders there. Brian R. Riley, the biggest shareholder. But then you got BlackRock. You got some others in there. But again, that is not good for that regional brokerage firm. All right, Nora, thanks so much for joining us. Nora Melinda, she covers all the markets for Bloomberg News. We appreciate getting a few minutes of our time. We got some primary coming up. And the people are up in New Hampshire, right?
New Hampshire.
That's kind of where we're going. All right. So, I mean, it's, they didn't have the debates there. The weekend shows didn't go. It's almost like we kind of know where this is going.
Well, because officially they're not an official primary, which is why Biden isn't on the ballot, but yet we're still making it count. So therefore, we still have to pay attention. I mean, and DeSantis dropped. So clearly, Iowa and then any polling numbers into New Hampshire did make a difference.
Yep, absolutely. Bloomberg's congressional reporter Laura Davison joins us here. She's up in New Hampshire. So, Laura, what's the feeling up there in New Hampshire? Is this kind of a fait accompli? I mean, it just seems like it's preordained that it's former President Trump's move to the nomination. What's the feeling up there in New Hampshire?
Yeah, especially after Ron DeSantis dropped out yesterday, and it's now a two-person race between Trump and Nikki Haley. The race is solidified, and some 2 new polls came out last night. Both showed Trump, about 15 points ahead of Haley. She has been competitive in the state. She's been campaigning. This is one of the states where she has the ability to come closer to Trump. Even potentially beat him, but that's looking more and more like a long shot as Trump racks up a bunch of endorsements from DeSantis, from Tim Scott, from Vivek Ramaswamy, and the field really seems to be solidifying behind Trump.
Why did DeSantis drop out yesterday? What was a strategy here?
Yeah, so DeSantis was not poised to do well in New Hampshire. He was polling in the single digits. You look out further, South Carolina and the Super Tuesday states, again, not doing particularly well, still trailing Trump. So by dropping out now, he, avoids a embarrassing third place finish, as well as potentially can get into Trump's good graces and the party's good graces.
So it's 2028. So that's about 2028.
Exactly.
So, all right. So for Nikki Haley here, what is a win here? I mean, can she win? Does she just have to show solid performance, or is there really nothing she can do here?
A win would be a huge win for her. It would improve the theory of her campaign, which is that there are, half, if not a little bit more, of Republicans who want someone other than Trump to be president. Even if she comes close, but she'd need to come really close, close to that 50% mark, to be able to sort of kind of keep her campaign going. If she is far behind Trump, that gives her a third place finish in Iowa, a distant second in New Hampshire, then on to South Carolina, which is her home state. But polling there right now suggests that Trump is far ahead. She has a month to potentially close that gap if she has a strong performance in New Hampshire. But really, this is her best spot on the map for now. Looking forward, it's a little bit more grim.
So to Paul's question, what is a win? It's not going to be an absolute win. So percentage-wise, what's a win?
She would need to get, something, we're talking, upper 40s% of the vote. Now that it's a two-person race, presumably, the Chris Christie vote, has gone mostly to her. The DeSantis vote, likely largely to Trump. So she needs to prove that she has, maybe about half of the Republican Party, kind of round up a couple percentage points.
All right. If I'm the Republican National Committee here, what do I do here? I mean, do I just fall in completely behind former President Trump and prepare for the general election? Is that kind of the expectation?
Yeah, they'll wait and see, until Haley is officially out. If she does in fact drop, it is likely that if it's clear she has no path forward, she will do what DeSantis did yesterday and say, look, I'm out. She has a lot of money. She's been raising a lot of money, but she's also been spending a lot. So she likely doesn't have a ton of runway if, it's clear that there's no path to victory. And same with the National Party. They're already preparing for a general election. You've seen the Trump campaign already doing messaging and advertising, hitting Joe Biden. Joe Biden's also already doing the same, preparing for a rematch with Trump.
I forget where I was reading this, but there was a nice article that said that the street is finally waking up or the general public, to the possibility of a Trump versus Biden rematch, legit. And everyone's like, oh, wait, no, I don't want that. What happens after that, sinks into the psyche of the American public? Can anything be done at that point?
There's one kind of last hope for people who don't want either Trump or Biden, and that's some sort of third-party candidate. So there's a group called No Labels that's been looking at, having some sort of centrist, maybe even bipartisan ticket, pulling someone like Larry Hogan or Joe Manchin, who have a lot of appeal, both with moderate Republicans and with Democrats. Again, that's not likely to be, a winning combination unless something, really unprecedented happens in American politics. Third parties just don't have the hold. But what that could play is either spoiler for Trump or Biden. If it's, depending what coalition of voters they pull together, 10, 15%, that could really swing the election one way or another.
So I guess, again, if I'm the RNC here, if I think about it, my presumed candidate, former President Trump, other than 2016, does not have a great record. Lost in 2020, midterms, disappointing, various houses of Congress. What do I do? What's the messaging really coming from the RNC here? Do they think they can win with this candidate?
Jenny, you there?
Oh, I think we had a little bit of a freeze there.
But you know what, Paul? I think that's a really good question because I don't know if it matters. Whether they can think anything they want, but they may not have a choice.
No.
Clearly, getting the nomination is one thing, but I think the question for me is what happens to either the independents or the centrist Republicans, and quite frankly, centrist Democrats.
Right.
Do they then stay home?
Exactly.
And then what does that do if you remove them from the voting base?
Yeah, and that'll be interesting to see. So it appears that we're going to have these primaries, this primary tomorrow in New Hampshire, and then they're going to go to Nevada. Joe Matthew was telling me that's next, and then South Carolina, where surprisingly, former President Trump is polling well ahead of Nikki Haley in her home state.
That's gonna hurt.
So Joe Matthew was suggesting that this thing could be over, before you even get to South Carolina. Forget about the Super Tuesday. It'll be over then, and then what do you do?
Which then makes me question, too, when and what do the markets wind up pricing in? There is a narrative that we're going to see the deficit move and explode no matter who is in the White House, right?
Yep.
It just for different reasons. Particularly if you have the Trump tax cuts are actually put in permanently, then you see bigger deficits. Then what happens? And do you have a moment where then the bond market can take control and say, no, we want something different? Does that happen? Does it not? What does that look like?
Yep, so it'll be a lot it's just going to be obviously an extraordinary year, as most presidential election years are, and certainly the stakes are very high here. WTI crude oil, $74 a barrel. What do you make here of what's going on out there in oil? It just seems like it's a a demand situation here. That's kind of what's driving the price, because I keep hearing OPEC and OPEC Plus talk about constraining production, but I'm not sure that's the deal.
I appreciate Paul throwing me a nice oil softball here on my first day on radio. But you know what I think is really interesting, and I can tie this to Trump also, is it's actually been more of a supply issue from the U.S.
Yes.
I mean, we're at record production. We beat Saudi Arabia in terms of production. I don't know if that's going to go away anytime soon. The growth rate might be slower, but it will still be growing. In which case, when you have the drill, baby, drill, like as President Trump was talking about earlier, it's like, to what end?
Right.
How much more can you drill? And if you do, then what winds up happening to the price? Good for consumers, maybe not as good for companies. OPEC doesn't like that, and that brings you in to more conflict.
And I will bring it right down to the John Tucker level. $2.90.
I don't put crude oil in my car.
$2.90 a gallon.
Yeah, it's popped up back over $3.
I got $2.90 yesterday.
You did?
Yes.
In Jersey?
In Jersey. The BP on Route 35 in Walton.
Refining capital of the U.S.
I've
got a refinery in my backyard.
We import all the products. Not all imports.
That's right, because we don't have
the
that's right, because we don't have, what's
we
that,
don't
the
have
Jones
pipelines.
Act.
And we have the Jones Act, yes.
Right, so, but I mean, Route 36, the Wawa, still $3, right?
And that's like a big billboard. You're going down the highway, the gasoline prices flashing, $2.90, just under $3 or whatever. And I think that contributes significantly to overall consumer confidence and inflation expectations.
Well, we saw that very much on Friday with the Immerse preliminary read for January. Gas prices go down, people feel better. Like, straight up, end of story. It's sort of that simple. You have to wonder, though, what if it goes back up?
Yep.
So look at the price today, and then it disrupts all the confidence as well.
All right, one day you're going to sit down and explain to us in great detail oil prices and how that translates into the final refined product that I put in my tank. Because it's not always a clear path, is it? I mean, crack spreads and all sorts of things like that.
I mean, how much time do we have? I can definitely go into this. It matters about the refiners. Do they refine heavy crude or light crude? I mean, we can talk about this.
And it's diesel, and you make all the stuff.
Well, the
out
diesel
of it.
is more expensive, but it's just like my understanding is the margins aren't as good for diesel fuel as it is for gasoline that the cars use.
And also, it's really about the gas station. Like, they're not going to take down prices as fast as they increase prices. They want to keep some kind of margin.
Oh, and why is it priced in tenths?
Okay, that I actually don't know.
Right, but that's
Somebody's
just an
gonna
old
find
convention, I think, just from back in the day. I remember you asked about it, and I Googled it, and there was a reason, because back in the day, back in the day when a gallon of gas was 7 cents, the tenth meant something. But now that it's $3, it doesn't mean as much. But yet, that's just convention. I don't know. Matt Miller tried to get me to buy a diesel with my last car. I'm like, look at the price of diesel. I'm not doing that.
Why would you do that?
Because he's a nut.
That's why you have me here now. Be like,
exactly.
No diesel for
yeah.
that.
So I bought just a regular old internal combustion engine. Very happy. S&P 500 we're up 0.5%. Nasdaq up about 0.75%. But check out the small cappers. The Russell 2000 up 1.9%. We're gonna have more coming up. Alex Steele, Paul Sweeney will be with you in just a moment.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash with the S&P 500 continuing its advance above 4,800, led by gains in big tech. Treasury 10-year yields declining 3 basis points. We are at 4.09%.